So starting off with our very first head of income, salaries head, let's revise this head of income very nicely. We'll start with basic concepts and we'll go on till the very end, covering each adjustment nicely, properly, so that you are very well prepared to handle the examination. Let's start with the very basics now. In your salaries head of income, first of all, who is your assessee? Your assessee is the employee, right? If your assessee is the employer, you will go to the PGBP head of income. You will come to the salaries head of income only if your assessee is employee. Okay. Point number 2, you can apply this head of income only if there is an employer-employee relationship, only if there is a master-servant relationship. The employer is giving salary to the employee. The employer is giving bonus to the employee. So anything which the employee receives because of the employer-employee relationship or because of the master-servant relationship, that only you can bring under the salaries head. If there is a principal-agent relationship, like for example, the principal gives commission income to the agent, right? That will not come under the salaries head because there is no master-servant relationship. So the precondition to put any income under the salaries head is that there must be a master-servant relationship, an employer-employee relationship. This is my very first point. Then comes my second point. What about MPs and MLAs? See, MPs and MLAs, we can't call them as employees of the government. So there is no employer-employee relationship, which means no salaries head. So first of all, salaries head is eliminated. Then what about their incomes? Their incomes will be taxed under which head? Their incomes will be taxed under the IFOS head. Let me give you that IFOS revision also now itself. See, it all depends upon is your employee, is your MP or MLA following the normal regime or is he following the default regime 115 BSE. Okay, if he follows the normal regime, whatever salary he gets, the salary will be taxable, but under which head? Not salaries head, because there is no employer-employee relationship, so it will go to the IFOS head. But in addition to salaries, the MPs and MLAs, they also get two allowances. They get daily allowance and they also get constituency allowance. Okay, this daily allowance and constituency allowance under the normal regime will be fully exempt. Okay, but however, on the other hand, if the assessee is following the default regime, that is section 115 BSE, then in that case, salary income will still be taxable under the IFOS head. But however, these two allowances which are exempt under the normal regime, even these will become taxable under the default regime. Okay, so MPs and MLAs, this is an IFOS concept, guys. I just brought in over here itself so that it gets indirectly revised for you. So MPs and MLAs, first of all, their income will not come under the salaries head because there is no employer-employee relationship. So whatever income they get, that income will be assessed under the IFOS head. Salary income will be taxable, daily allowance, constituency allowance will be exempt. However, if that MP or MLA is following the default regime, then all the incomes will be taxable under the IFOS head. Okay. Then comes my next adjustment. What about partners? Even partners of partnership firm, partners of LLP, even they get salary from the firm, guys, especially active partners, they get salary from the firm. So that salary will not come to the salaries head. That salary will go to the PGPP head. You know it very well. Why? The reason is same reason even over here. There is no employer-employee relationship. You can't say that the firm is employer and partner is employee. No, because you must have learnt in a CA foundation that between the partners and the firm, there's a principal-agent relationship, right? There is no employer-employee relationship. So therefore, whatever salary the partners get from the firm, it will go into the PGBP head and not into the salaries head. Okay, so these were your three main points over here in my first discussion. Now comes my next discussion, my second discussion. Only from MCQ point of view this can be relevant. There are two concepts which we are going to compare. One is foregoing of salary and the other is surrender of salary. Let's focus on foregoing of salary first. This one is an interesting discussion. See, when I talk about foregoing of salary, what is happening over here is a waiver of salary. I'll give you one example straight away. Okay, let us say my salary income is 1 lakh. Alright, now I'm telling the employer, listen employer, don't give me full 1 lakh, give me only 90,000. This balance 10,000, employer, what you do is this balance 10,000 you give as a donation towards charity. Okay, so how much did I receive in hand? In hand I received only 90,000, right? But the question is now, when you're doing my total income computation, how much salary will you consider? Will you consider 1 lakh or will you consider 90,000? You will consider full 1 lakh, guys, because it is as if I have received this 1 lakh, it is as if I have earned this 1 lakh, and after earning the 1 lakh, I have spent the 10,000. Okay, so basically foregoing of salary is nothing but waiving of salary. It is nothing but as if you have applied the salary. It is an application of income. So it is as if you have earned the full 1 lakh and after earning 1 lakh you have spent 10,000. So what you do with the money after you earn the money, I don't care. According to the government, your salary income is 1 lakh. So in simple words, even if you forego salary, even if you donate 10,000 rupees of your salary, if you donate, doesn't matter, we will still consider your salary income to be the whole 1 lakh only. This is foregoing of salary. But however, when you surrender salary, now when can you use this term surrender? You can use this term surrender only if you are surrendering salary under the voluntary surrender of salaries exemption from Taxation Act 1961. Under this act, if you are surrendering salary, then that is going to be exempt. Like for example, same thing I'll tell you, my salary was 1 lakh. I surrendered 10,000 rupees under this act, I surrendered. Okay, so in that case, how much salary will be taxable for me? In this case only 90,000 salary will be taxable for me. So whatever amount of salary I surrender under the voluntary surrender of salaries exemption from Taxation Act 1961, to that extent my salary will be exempt. But can you say the same thing for foregoing of salary also? No, even if I forego 10,000 rupees of my salary, doesn't matter. It is as if my salary income is still full 1 lakh. But when I surrender salary under this particular act, then the amount of salary which I have surrendered, that is going to be fully exempt. Okay, so this was about foregoing of salary and surrender of salary. Now comes my third discussion, which is about section 15. Section 15 is a charging section of your salaries head. Section 15 very clearly says that salary will be taxed on due basis or receipt basis, whichever is earlier. See, in the salaries head of income, what method of accounting your employee is following, it doesn't matter. Method of accounting is relevant only in two heads, guys, PGBP and IFOS. Okay, so in the salaries head, what method of accounting employee is following is irrelevant, because the law itself is telling us that when should the salary be taxed. Salary should be taxed on due basis or receipt basis, whichever is earlier. Now when you look at advance salary, in advance salary what is earlier? Here receipt is earlier. So as soon as you receive the salary, it will be taxed for you. In arrears of salary, what is earlier? Here due is earlier. So as soon as salary is due, it will be taxed for you. So even though you haven't received the salary, if salary is due, it will be taxed for you. So salary will be taxed on due or receipt basis, whichever is earlier. Okay. Then comes my next discussion about grade scale. Now this is a concept which generally comes into the picture when you actually solve questions. Like this is one example of grade scale which I have put over here. 60,000, 1,000, 78,000. Now how do you interpret this? This indicates that your starting salary will be anywhere between 60,000 and 78,000. It can be anywhere in this range. It can be anywhere in the range of 60 to 78. But in case the examiner does not tell you that what is the starting salary, then you will assume that the starting salary is 60,000 itself. So let's take an example. Let's say our employee was hired on 1st February 2024, okay, with starting salary of 60,000. So 1st February 2024 to 31st Jan 2025, his salary is going to be 60,000. Then 1st February 2025 to 31st Jan 2026, his salary will be 61,000 per month salary, monthly salary. Okay. So what grade scale indicates is that every year his monthly salary will get 1,000 rupees increment till it reaches 78,000. So 60, 61, 62, 63, every year his monthly salary will keep increasing by 1,000 rupees. Okay. Now what about our 24-25 previous year? In our examination, previous year is 24-25. So how will you calculate? Now see, till 31st Jan 2025, the salary is 60,000 per month. So you will calculate like this. So April to Jan, that is for these 10 months, your basic salary will be 60,000 per month. Then the remaining 2 months, Feb to March. So Feb 25 onwards, salary is 61,000 per month. So for these 2 months, it will be 61,000 per month. Okay. So this was purely from the computation point of view in case they give you a grade scale. Okay. So now I'll move on to the fifth concept now. One very important tip that you should remember throughout your salaries head of income. See, for allowances and for retirement benefits, you will see how much did your assessee receive. Out of that, how much is exempt, the balance will be taxable. Received minus exempt, balance will be taxable. But however, for perquisites, you will straight away compute the taxable value. For allowances and for retirement benefits, you will first calculate how much is exempt. Okay, then received minus exempt will become taxable. But for perquisites, like for example for RFA, for motor car, you don't calculate the exempt amount over there. You straight away calculate the taxable value for perquisites. Alright, so these were 5 points on your first page. Now come to the next discussion. Our next focus is going to be fully on the allowances. Let's take up the allowances one by one. We will be discussing the allowances in totally 4 parts. In my very first part, I am talking about 5 specific allowances. Number 1, tribal area allowance, which is also called called as agency area allowance, which is also called as scheduled area allowance. Here you will get straight away 200 rupees per month exemption. So this is your exemption. So received minus exempt, balance will be taxable. Then your second is children education allowance. Here you will get 100 rupees per month per child exemption for maximum 2 children. Then number 3 is children hostel allowance. Here you will get 300 rupees per month per child exemption, again maximum 2 children. Then transport allowance, your exemption will be 3200 per month, but only for blind, deaf, dumb and orthopedically handicapped employees. And lastly, if you get any allowance because you are working in the transport sector, like for example if you are a pilot, or if you are an air hostess, or if you are a driver, or if you are a conductor, that is if you are working in the transport sector, then to help you meet your day-to-day expenses, the employer may give you an allowance. So with respect to that allowance, you will do 2 calculations, okay. One is 10,000 per month, second is 70% of allowance received. Out of these two numbers, whichever is the lesser number, that lesser number will become your exemption. So received minus exempt, balance will be taxable, guys. So the special point about these 5 allowances is that in these 5 allowances, see, I don't care what your actual expense is. How much you actually incurred, it doesn't matter for me. Like for example in transport allowance, how much you actually incurred for transportation, it is irrelevant. You will straight away get a flat exemption. Alright, so the numbers are fixed in the act itself. The rules itself give you the numbers. To this extent, it will be straight away exempt for you. So received minus exempt, balance will be taxable. Okay, so come on, tell this to me one last time. Tribal area allowance, scheduled area allowance, agency area allowance, 200 rupees per month will be exempt. Children education allowance, 100 rupees per month per child will be exempt for maximum 2 children. Children hostel allowance, 300 rupees per month per child will be exempt for maximum 2 children. Transport allowance, 3,200 per month will be exempt, but only for blind, deaf, dumb and orthopedically handicapped employees. What about other employees? For other employees, no exemption. So for other employees, transport allowance will be fully taxable. Okay. And lastly, allowance for employees in transport sectors, 2 things you will calculate. 10,000 rupees per month, 70% of allowance received. Out of these two numbers, whichever is a lesser number, that will be your exemption for the computation. Okay. Now see, let us talk a little more in detail about these two, children education allowance and children hostel allowance. Sometimes the examiner calls this as combined allowance. Combined allowance means children education allowance also, hostel allowance also. So if it is combined allowance, how much exemption you will get? 400 rupees per month per child exemption you will get, same maximum 2 children. So combined, your first special point was about combined allowance. It is nothing but children education allowance plus children hostel allowance. Then see, for children education allowance, for children hostel allowance, you must have spent some amount. How much you actually spent doesn't matter. I just told you, right? You straight away get an exemption in these 5 allowances. How much you actually spent is irrelevant, but you should have spent some amount at least. When will he have some expense? Only if he is having children. Those children go to school, that school must be in India. Then he will be having some expense. If he is having some expense, only then we will give him the exemption. But how much is the expense? How much is the actual expense? That amount, that is irrelevant. So there are 2 special points over here for children education allowance and children hostel allowance. The first special point was about combined allowance. Combined allowance is nothing but education allowance plus hostel allowance. So how much exemption will you get over here? 100 for education allowance, 300 for hostel allowance. So total 400 rupees per month per child exemption you will get, even over here maximum for 2 children. Then your second special point was that how much my assessee has actually incurred doesn't matter, but some expense he should have. Now when will you say that okay, he is having some expense? You can say he is having some expense only if he has children. Those children go to school and the school is in India. Only if these 3 conditions are fulfilled, you can say that he is having some expense in India. Only then you will give him the exemption. Okay. And lastly, see, in case your assessee is having multiple children, remember when you are doing the computation, do computation for each child separately. I'll tell you why. Like for example, let us say for child 1, let's talk about children education allowance. Okay, for child 1, children education allowance, my employee received 1000 rupees. Alright, so how much exemption will you be giving over here? 100 rupees per month. So 100 into 12 will become 1200 rupees, which is more than 1000. Can exemption be more than what you received? Of course not. So the exemption, even though it is 1200, you will restrict it to 1000. Let's say for child 2, your employee got 1500 rupees children education allowance. Here how much exemption will you get? 100 rupees per month. So 1200 exemption you will get. So your total taxable number will be 300. Okay, but if you don't do for each child separately, if you do for both the children together, then what will happen? You will say, okay, I received 1000 plus 1500, I received 2500, out of which how much is exempt? 100 rupees is exempt for per month for per child for 2 children. You will say 2400 is exempt. So balance 100 is taxable, you will say. Are you noticing? Your answer is different. So your answer will be wrong. So especially whenever the amount of allowance received is less than the 1200 number for children education allowance, or if it is less than 3600 for hostel allowance, then remember to do for each child separately, because otherwise if you do for children together, then you will end up getting a wrong answer. So remember this point for both children education allowance also, hostel allowance also, do for each child separately. It will not take you too much time, but it will ensure that your answer is 100% accurate. Okay. Now, this 2 children limit we're talking about, right, in children education allowance and children hostel allowance. In our entire intermediate syllabus, where else do you have this 2 children limit? In totally 4 places only in our syllabus. One is children education allowance, the other is children hostel allowance, third is in LTC, leave travel concession, and fourth is tuition fees, section ATC. So only in these 4 places only you have the 2 children limit, not anywhere else. Children education allowance, children hostel allowance, LTC, and tuition fees in section ATC. So if you're noticing, out of these 4 places, 3 places are in the salaries head itself, and 1 place is in chapter 6A ATC tuition fees. Okay, so this was it about the discussion regarding the first part of allowances, where we spoke about 5 specific allowances. In these 5 allowance, how much is going to be exempt is given in the act itself. For these 5 allowances, employee must have incurred some amount. How much he has incurred doesn't matter, but he must have incurred some amount. Okay, then comes my second part of allowances, 7 allowances. So for these 7 allowances, whatever your assessee has incurred for official purpose, whatever expenditure he has incurred for official purpose, that alone will be exempt. So here, how much assessee has incurred for official purpose is relevant. It is perfectly relevant, because whatever he has incurred for official purpose, that only is going to be exempt. Received minus exempt, balance will be taxable. Okay, so what are these 7 allowances? Number 1, you have travelling allowance, then you have conveyance allowance, then you have transfer allowance, then daily allowance, helper allowance, research allowance, uniform allowance. So you have first of all travelling allowance, then you have travelling and conveyance, both interconnected guys, travelling allowance, conveyance allowance, then another T, transfer allowance, and then D, how are you, daily allowance, helper allowance, research allowance, uniform allowance. Now please remember that research allowance is also called as academic allowance, okay, and helper allowance is also called as personal assistant allowance. It is also called as servant allowance. So these are your 7 allowances. These 7 allowances, whatever your assessee has incurred for official purpose, that alone is exempt. Received minus exempt, balance is taxable. And mind you, whatever discussion I am doing with you right now, it is entirely under the normal provisions, not under 115 BAC. 115 BAC plus salaries I will discuss with you a little later. Okay, then let's go to the third part of our allowances. I told you total 4 parts, right? First 2 parts were done. Coming to the third part, here we are going to target only and only HRA. Now see, with respect to HRA, totally 4 steps in your calculation, okay. You will start with salary for HRA. That salary will have 3 components: basic salary, DA forming part of retirement benefits, and employees turnover based commission. Don't take fixed commission, take only turnover based commission. So you will first calculate salary, then you will see how much HRA was actually received, then you will calculate exempt HRA, received minus exempt, the balance will be taxable. Right guys, so you will first compute salary for HRA, then you will see how much HRA was received, out of which how much is exempt, received minus exempt, balance is taxable. Now see, you will give exemption only if 2 conditions are fulfilled. Condition number 1, assessee must be having some rent expense, and condition number 2, he must have opted out of 115 BAC. Only if these 2 conditions are fulfilled, only then you will even do exemption calculation. Otherwise HRA will be fully taxable. See, if your assessee is an employee, okay, and he is receiving HRA, but he is not even paying rent, then HRA amount will be fully taxable for him. Or if your assessee is an employee, he is receiving HRA, but he is following 115 BAC. Even in that case, you will not calculate any exemption. It will be fully taxable for him. So exemption calculation you will do only if these conditions are fulfilled. What are the conditions? Condition number 1, first of all, your employee must be having rent expense. And condition number 2, your employee should have opted out of 115 BAC. Only if both these conditions are fulfilled, only then you will do exemption calculation. Now, how to do the exemption calculation? 3 things you will calculate. Out of the 3 things, whichever is the least will become exempt. Okay, what are the 3 things? Number 1, 50% of salary if employee is living in a metro. Metro means what? Delhi, Mumbai, Kolkata, Chennai. If employee is living in a metro, 50% of salary. If employee is not living in a metro, then 40% of salary. Second, actual HRA received, and third, rent paid minus 10% of salary. So out of these 3 numbers, whichever is the least number will become your exemption. So received minus exempt, the balance will become taxable. Okay, so this is your HRA calculation, but please remember you will do the exemption calculation only if two conditions are fulfilled. First of all, your employee should be having rent expense, and secondly, he must not be following 115 BAC, he must be following the normal provisions. Only then you will do exemption calculation. Okay, then listen to the fourth part, your fourth category of allowance. We're talking about entertainment allowance. See, with respect to entertainment allowance, there will be totally two tax treatments. Okay, first, whatever allowance is received, we will tax it under the salary set, tax it for all employees. Second, you will get section 16 deduction, but only for central government or state government employees and only under the normal regime. Alright, so point number one, it's going to be taxable for all employees. Doesn't matter what kind of employee, doesn't matter whether normal regime or default regime, doesn't matter. You will first tax it for all employees. Then you will give section 16 deduction, but only for central government or state government employees and only under the normal regime. Now, how much section 16 deduction will you get? It depends upon three factors. Point number one, 5,000 rupees. Point number two, 20% of basic salary. And point number three, how much entertainment allowance have you received? Out of these three numbers, whichever is the least number, that is what your section 16 deduction will be. So 5,000 rupees, 20% of basic salary, actual entertainment allowance received. Out of these three, whichever is the least will be your section 16 deduction. So totally two tax implications. Number one, you will tax the income, you will tax it for all employees under both the regimes. Number two, you will get section 16 deduction, but this you will get only for central government, state government employees and only under the normal regime. Okay, so totally four categories of allowances, all the four we have seen. In the first category, we had 5 allowances, guys, where what is exempt is given in the act itself. Children education allowance, children hostel allowance, transport allowance, allowance for employees working in the transport sector and tribal area allowance. In the second category of allowance, remember we had 7 allowances, your travelling allowance, conveyance allowance, transfer allowance and D, how are you? Those 7 allowances, whatever you have actually incurred for official purpose, that is going to be exempt. Received minus exempt, balance is taxable. Third category was HRA. Even over here, received minus exempt is taxable, but you will do exempt calculation only and only if assessee first of all has rent expense, and secondly assessee must be following the normal regime and not 115 BAC. And our fourth category of allowance was entertainment allowance. Now, in case you get any other allowance which is not covered in these four, like for example medical allowance or lunch allowance or telephone allowance or city compensatory allowance, any other allowance which we have not discussed is going to be fully taxable. Nothing is going to be exempt. All other allowances fully taxable. So with this we are done learning with all our allowances discussion. So we learnt about the basic point about employer-employee relationship. We spoke about foregoing of salary and surrender of salary. Then we discussed salary is taxed on due basis or receipt basis, whichever is earlier. We discussed about grade scale, and then we learnt about all the allowances. Now let's focus on our next discussion, which is going to be about two important things, RPF and URPF. Let's take them up one by one. Let's talk about RPF first. Now in your RPF discussion there are two adjustments, guys, or in fact there are three adjustments. You have employer's contribution, you have employee's contribution, and then you have interest on RPF. So totally 3 adjustments you have. Let's talk about them one by one. Let's talk about employer's contribution. Here we will always do the computation in the form of 4 plus 1, 5 steps. Your first step will be calculating salary for RPF. That salary will have 3 components, same 3 components which you had in HRA also. Basic salary, DA forming part and employee's turnover based commission. Then your second step will be actual contribution of the employer. Third step will be exempt contribution. How much will be exempt? 12% of salary. Which salary? The salary which you just calculated over here. And your fourth will be taxable contribution, which will be nothing but received minus exempt. So if you notice, your 4 steps are very similar to what you do in HRA. Even over there you first calculate salary, you see what is the actual HRA, and then you see how much is exempt HRA, and received minus exempt, balance is taxable. Here also it's the same way only the computation will be slightly different. Okay, so you will start with salary computation, 3 parts, then you will see what is the actual contribution of the employer, the exempt contribution will be 12% of salary, received minus exempt, balance will be taxable. These are your first 4 steps, but I told you for employer's contribution we do 4 plus 1, 5 steps. So after you do these 4 steps, you will get one taxable number over here, guys. This received minus exempt, balance is taxable. So in addition to this, there will be one more taxable number which you will get out of your 5th step. In your 5th step, you will see how much is employer's contribution to 3 things, to RPF, superannuation fund and NPS put together. If the employer's contribution to these 3 things put together is more than 7,50,000, then you will see how much is the excess. The excess will be taxable as perquisite. Then on the excess, how much is the interest? Even that interest will be taxable as perquisite. So you will get a taxable number from how many places for employer's contribution? From 2 places, from your 4th step also, from your 5th step also. Okay. So what are your 4 steps? You will start with salary for RPF, then how much is the actual contribution, then exempt contribution which is 12% of salary, and received minus exempt, balance will be taxable. So out of these 4 steps you will get one taxable number. Then in addition to this you will check is employer's contribution to RPF plus NPS plus superannuation fund put together more than 7,50,000. If it is more than 7,50,000, then you will see how much is the excess. The excess will also be taxed as perquisite, and interest on the excess, even that will be taxed as perquisite. Okay, so this was about employer's contribution. I was telling you in RPF there are 3 adjustments. Employer's contribution, first adjustment is done. Then comes employee's contribution. Here you have only 2 steps. Your first step will be entire employee's contribution will go to section 80C, chapter 6A. Okay. Your second point in employee's contribution is that you will see how much is the employee's contribution. Is it more than 2,50,000? If it is more than 2,50,000, you will find the excess. Excess is not taxable. On the excess, how much is the interest? That interest will be taxable under the salaries head. Okay. So employee's contribution, 2 steps. Number 1, you will first straight away give section 80C deduction, and number 2 is employee's contribution more than 2,50,000. If it is more than 2,50,000, then what is the excess? Excess is not taxable. Did you notice? For employer's contribution, even the excess was taxable, even interest was taxable. You had 2 taxable numbers over here. But for employee's contribution, the excess is not taxable. On the excess, what is the interest? That alone is taxable under the salaries head. Okay. So employer's contribution, first adjustment. Employee's contribution, second adjustment. Third is your interest on RPF. Interest on RPF up to 9.5% is going to be fully exempt. If it is more than 9.5%, the excess above 9.5%, the excess will be taxable. So totally 3 adjustments. Employer's contribution you will remember as 4 plus 1, 5 steps. And how many places you will get the taxable number from? From the 4th step also, from the 5th step also, from 2 places you will get the taxable number. For employee's contribution, you have only 2 steps. Number 1, section 80C deduction. Number 2 is the employee's contribution more than 2,50,000. If it is more than 2,50,000, the excess is not taxable. Interest on the excess alone is taxable. Okay. But however, here there is one more point. Okay. If the employer is not contributing, that is only employee is contributing. If employer is not contributing, then instead of 2,50,000, you will take the 5,00,000 number. Generally, it is 2,50,000, but if the employer's contribution is 0, then you will replace 2,50,000 by 5,00,000 rupees. Okay. Employee's contribution, 2 steps. And what about interest? For interest up to 9.5% per annum will be exempt. If the interest is more than 9.5%, whatever is the excess above 9.5%, the excess alone will be taxable under your salaries head. Okay. So this was about your RPF discussion. Then coming to your URPF discussion. URPF, see, year on year, no tax implications. Tax implication will arise only when your assessee withdraws money from URPF. So when he withdraws the money from URPF, we will split that money into 4 parts. Number 1, how much is the employer's contribution, how much is the interest on employer's contribution. These 2 will go to the salaries head and will be taxed. Then we will see how much is employee's contribution, we will fully ignore it. And then interest on employee's contribution, this will be taxed but under the IFOS head. So URPF, only at the time of withdrawal only tax implications will arise. We will divide the amount that we are withdrawing into 4 parts. Employer's contribution and interest on employee's contribution will go into the salaries head. Employee's contribution I will ignore, and interest on employee's contribution will be taxed under the IFOS head. Okay, so until now if you see, we are done learning about our basic points. We've learned about grade scale also. We've learned about all the allowances, and we've learned about RPF and URPF. Okay, now our next focus is going to be on one very small concept called specified employees, because after I discuss this, my next discussion with you is about the perquisites. But before we start learning about perquisites, we first have to understand who are specified employees, because there are some perquisites which are taxable only for specified employees. So we need to know who are these specified employees. See, a specified employee is an employee who fits under any one out of these 3 criteria. Either the employee must be a director, or the employee must be having substantial interest, that is at least 20% equity shares at any point of time during the previous year, or this employee's taxable salary minus non-monetary perquisites, the balance salary should be more than 50,000 per annum. See, taxable salary means after section 16 deductions. Non-monetary perquisites means all the perquisites which he has received in kind, like RFA, motor car perquisite. So all the perquisites which he has received in kind. So taxable salary minus non-monetary perquisites, balance salary should be more than 50,000 per annum. Now in your examination, most of your questions, your employee will be a specified employee, because the employee will be mostly getting covered under this 3rd point. Because salary will be generally more than 50,000 only per annum. This is not monthly limit, this is per annum limit. Okay, so specified employee means an employee who is getting covered under any one out of these 3 criteria. Either the employee is a director, or the employee is having substantial interest at any point of time during the year, or taxable salary minus non-monetary perquisite is more than 50,000 per annum. Okay. Now see, there are some perquisites I was telling you which are taxable only for specified employee. Number 1, motor car. Number 2, education facility. Number 3, facilities of sweeper, gardener, watchman, personal assistant and all. And number 4, gas, electricity, water supplied by the employer for household consumption of employee. So there are 4 perquisites only which are taxable only for specified employees, not taxable for non-specified employees. Motor car perquisite, which we will be learning. Education facility, then sweeper, gardener, watchman, personal attendant facility, not reimbursement. See, if it is a reimbursement, then it will be taxable for all employees. We are talking only about facilities over here. And lastly, gas, electricity, water supplied by the employer for consumption of employee. So even over here, if it is reimbursement, it will be taxable for all employers. These 2 points, in fact these 3 points, I am talking only about facilities. Okay, I am not talking about reimbursements. Reimbursement will be taxable for all employees. Facilities only will be taxable for specified employees only. Okay, now let's go to our perquisite discussion. Let's start off with our very first perquisite, the most important perquisite, which is RFA. Now when it comes to RFA, the first thing you will check is who is your employee. Is he a government employee or is he non-government employee? If he is a government employee, the license fee will straight away be taxable. Okay, if it is a non-government employee, you will now check whether the house is owned by the employer or whether the employer himself has taken it on lease. If the house is owned by the employer, the taxable value of RFA will depend upon the population of that place where the house is situated. Population as per 2011 census. Okay, if the population is up to 15 lakhs, then 5% of salary will be taxable. If the population is more than 15 lakh but up to 40 lakhs, then 7.5% of salary will be taxable. And if the population is more than 40 lakh, then 10% of salary will be taxable. See, please note, for it's a perquisite, right? It's a perquisite. I am not calculating the exempt amount. I am straight away calculating the taxable amount. This 5%, 7.5%, 10%, these are straight away the taxable numbers. Okay, so if the employee is a non-government employee and if the accommodation is owned by the employer, then it will totally depend upon the population of that city as per 2011 census. 5%, 7.5%, 10%, 3 numbers we have over here. But however, if the employee has himself, if the employer himself has taken the house on lease, if the house is taken on lease by the employer, I don't care about the population. Okay, I will straight away calculate 10% of salary or rent paid by employer, whichever is lesser will be taxable. See, this 10% number will not depend upon population. If the house is taken on lease by the employer, the population is irrelevant. You will straight away calculate 10% of salary or rent paid by employer, whichever is lesser is taxable. Okay, so by doing this calculation, you will get the value of unfurnished RFA, taxable value of unfurnished RFA. Now, in case furniture is also provided by the employer to the employee, you will add the taxable value of furniture also. Now, how will you find the taxable value of furniture? It fully depends upon whether the employer owns the furniture or whether the employer has himself taken the furniture on rent. If the employer owns the furniture, you will take 10% per annum of the cost of the furniture. But however, if the employer himself has taken the furniture on hire, then you will add the higher charges paid by employer. So by doing this calculation, you will get the taxable value of unfurnished RFA. To this you will add the value of furniture and now you will get the taxable value of furnished RFA. Okay, now sometimes employee pays a small amount of rent to the employer. So whatever the employee has paid to the employer, you will subtract that and you will get the final value, taxable value of accommodation and concessional rent. See, if the employee is paying rent to the employer, you can't call it as rent free anymore, right? Because it is not rent free. Employee is paying some amount. So if the employee is paying some amount to the employer, you will subtract it. But you will not call it as rent free accommodation anymore. Instead, you will call it as accommodation at concessional rent. Okay. Now, one small discussion we need to have here, that when we say salary, what is the meaning of salary? Salary will have totally 7 components for the purpose of RFA. See, in HRA we had only 3 components. Same 3 components we had in RPF also. But in RFA we are having 7 components. Basic salary, then DA forming part, then all commission, whether it is fixed commission, whether it is turnover based commission, doesn't matter, all commission, bonus, fees, taxable allowances and other taxable monetary payments. Other taxable monetary payments, like for example, leave salary during service. See, it is a payment, which means it is not perquisite. You should not consider perquisites. When you are calculating salary for RFA, you should not consider perquisites. In this last box, we are talking about monetary payments. So, we are talking about money which employer has given to the employee, like for example, leave salary during service. It is money it is something which is taxable, leave salary during service. So these kind of transactions you will cover over here. You will not include perquisites, you will not include retirement benefits also, you will not include RPF also, advance salary, arrears of salary, even this you will not consider for the purpose of RFA. Only 7 components: basic salary, DA forming part, all commission, bonus, fees, taxable allowances and other taxable monetary payments like leave salary during service. What if it is leave salary upon retirement? You will not consider, because retirement benefits you are not supposed to consider. Advance salary, arrears of salary you are not supposed to consider. RPF contributions you are not supposed to consider. Perquisites also you are not supposed to consider. Okay. So when it comes to RFA, you will first find the value of unfurnished RFA, then you will add the value of furniture, you will get the taxable value of furnished RFA, then you will subtract whatever rent employee has paid to the employer, and now you will get the taxable value of accommodation and concessional rent. Okay. Now listen, what if the employer has given to the employee more than one RFA at the same time? In that case, up to 90 days. For the first 90 days, only one RFA we will tax. So you will find the taxable value of both the RFAs, whichever is lesser will be taxed for the first 90 days. But for the period above 90 days, for the excess number of days above 90 days, RFA 1, RFA 2 both will be taxed. So when will this provision come into the picture? Only if the employer has given to the employee 2 RFAs at the same time. So for the first 90 days, you will find the taxable value of RFA 1, taxable value of RFA 2, whichever is lesser. So only one RFA only you will tax for the first 90 days. But for the remaining number of days beyond 90 days, you will tax both the RFAs. Okay. Then listen, like for example, let us say the RFA is given by the employer to the employee in April itself, but the employee actually starts occupying that RFA only in June. So in that case, you will do calculation only June onwards. Then in case it's a guest house which the employer has given to the employee for pure official purpose, that's going to be fully exempt. Like for example, let's say the employer is going on an official visit. So the employer is giving him some guest house accommodation. It's purely for official purpose. So guest house accommodation purely for official purpose will be fully exempt. Alright. Then listen, in case the employer-employee relationship has come to an end, but still if the employee is continuing to occupy the RFA, you can't put it under the salaries head, because in our very first discussion we learned you can tax anything under the salaries head only if there is employer-employee relationship. So after the employer-employee relationship is over, if the employee still continues to occupy the RFA, you can't tax it under the salaries head. You will have to tax it under the IFOS head instead. Okay. Then what about RFA plus indexation? See, this you will do only if the examiner has given you the taxable value of RFA for previous year 23-24. For 23-24, if he has given you the taxable value of RFA, that is for last year if he has given you taxable value of RFA, only then you will do this extra drama. So what you will do is normal calculation you will do. You will find the taxable value, you will do the normal calculation. Okay, you will compare that number with indexed RFA of last year. So you will see last year 23-24's taxable value of RFA. You will multiply it with CII of current year 24-25 divided by CII of last year 23-24. So you will get the indexed value of last year's RFA. So you've already done one calculation for the current year. You will compare that calculation with last year's indexed RFA. Out of these two numbers, whichever is lesser, that will become your taxable value for the current year. Understanding? So I'm repeating once again. You will do this calculation only if the employer has given you the taxable value of last year's RFA. Okay, so like for example, he has told you 23-24's taxable value is 1 lakh for example. So in that case, first you will do normal calculation for current year. For current year, let's say your RFA number was 1,50,000. Okay, then you will compare this number with indexed value of last year's RFA. So last year's RFA is 1 lakh. This into CII of your current year 24-25 divided by CII of last year, which is 23-24. You will get one number over here. So out of these two numbers, whichever is the lesser amount, that will become your final taxable value of RFA. But this you will do only if the examiner has given you 23-24's taxable value of RFA. Okay. And lastly, if the accommodation is given in a hotel, motel, guest house or service apartment, then in that case 24% of salary or actual charges paid by employer, whichever is lesser, will become your taxable value. See, if the same guest house is purely for official purpose, then it will be exempt. But if it is for residence purpose, if it is not purely for official purpose, if it is for the purpose of residence of the employee, then 24% 24% of salary, or actual charges paid by employer, whichever is lesser will become taxable value. Okay, but if the same hotel, motel, guest house accommodation is given for up to 15 days, then nothing will be taxable. Up to 15 days because of transfer from one place to another, nothing will be taxable. Otherwise, generally hotel, motel, guest house, service apartment, 24% of salary or whatever the employer is paying to the hotel, whichever is lesser will be taxable. So this was your RFA discussion. Please remember, for RFA, your first part will be doing the calculation for unfurnished RFA. Okay, and here if the employee is non-government employee, you will check whether the accommodation is owned by employer or has the employer himself taken it on lease. If it is owned by the employer, then the taxable value of RFA will depend upon the population of the city where the house is situated, population as per 2011 census. Okay, but however, if the employee, if the employer himself has taken the house on rent, then 10% of salary or rent paid by employer, whichever is lesser, will be taxable. You are straight away calculating the taxable number over here, no exempt calculation. Finally, we learnt over here that how do you do salary computation? 7 components: basic, DA forming part, all commission, bonus, fees, taxable allowances and other monetary payments. Then we had learnt, once you find the taxable value of unfurnished RFA, you will add the value of furniture, you will subtract whatever amount employee has paid to the employer and you will get your final taxable value. Then if the employer has given to the employee more than one RFA at the same time, for the first 90 days you will tax any one, of course whichever is lesser. For the period beyond 90 days, you will tax both. Okay, then we learned that in case the employer has given the RFA in April itself, but employee actually starts occupying it only from June, then you will do calculation, taxable calculation only June onwards. And then we had learned if the guest house is purely official purpose, it will be fully exempt. Then once employer-employee relationship is over, even after that, if the employee continues to occupy the RFA, for that remaining period it will be taxed under IFOS head and not under salaries head, because there is no employer-employee relationship anymore. Then we learned that whatever is your taxable value of RFA, you will have to compare that with indexed RFA of 23-24. But you will do this only if the examiner has given to you 23-24's RFA. Then finally we learned hotel, motel, guest house, 24% of salary or rent paid by employer, whichever is lesser will become the taxable value. So this was your entire RFA discussion. Now see, sometimes the examiner asks you to find out HRA or RFA which is better on the basis of net take home cash benefits. So when this is a question, what you will do is, you will check if assessee is getting HRA, then what is the net cash in hand. If assessee is getting RFA, what is the net cash in hand. On that basis, wherever the assessee is left with more cash in hand, that will be more beneficial. See, your answer will not be on the basis of where the taxable amount is less. No, the criteria is net take home cash benefits. So, if assessee is getting HRA, how much cash in hand is he left with? If assessee is getting RFA, how much cash in hand is he left with? Out of these two calculations, out of these two computations, wherever he is left with more cash in hand, that will be more beneficial. But when you are doing this cash in hand calculation, remember to consider the tax computation also, because tax will also be one of the outflows, right? Because see, cash in hand means what? Cash in hand means cash inflow minus cash outflow, right? Like if your assessee is getting HRA, then cash inflow will be salary, cash inflow will be HRA, but cash outflow will be rent, cash outflow will be tax. So cash inflow minus cash outflow, how much is the net cash in hand you will calculate for HRA. Similarly, you will calculate for RFA also. So wherever your assessee is having more cash in hand, that is what is more beneficial for the assessee. That is how you will conclude. Regarding this, we had worked out a question in our class itself. In case you have not attended my class, and there is a question on this regard in your total income chapter in your ICAI study material. You can have a look at that question as well. Then after this, coming to the next discussion, what if the employer gives me a gift? See, if I get any gift from employer, it will come under the salaries head. If the gift happens to be in cash, then doesn't matter what is the value of the gift, it will be fully taxable. But if the gift happens to be in kind, or if it is gift vouchers, gift in kind, gift vouchers, up to 5,000 rupees, it will be fully exempt. If it is more than 5,000 rupees, you have two options. Either you can tax it fully or you can tax just the excess. 2 points of view we have. So cash gift fully taxable always, but gift in kind or gift vouchers up to 5,000, it will be exempt. If it is more than 5,000, either you can tax it fully or you can tax just the excess above 5,000. Okay. Then comes our next discussion about reimbursements. See, reimbursements are generally taxable and taxable for all employees. Okay. But however, there are two exceptions to this rule. One is telephone reimbursement, mobile phone bill reimbursement. This is going to be fully exempt for all employees. Then medical bills reimbursement, this will be exempt only and only if the reimbursement is happening in a specified hospital for a specified patient. See, generally reimbursements are fully taxable, but you have exempt reimbursements only in two cases. Telephone and mobile phone bill reimbursement always fully exempt. Okay, medical bills reimbursement also generally taxable, but only if the treatment happened in a specified hospital and the patient is a specified patient, only then medical bill reimbursement will be exempt. So what is specified hospital? Government hospital, hospital approved by the government, hospital approved by the Principal Commissioner of Income Tax. So the treatment happened in approved hospital, and who is a patient? A patient is 3D plus spouse. 3D plus spouse means what? If I am the assessee, my brother, my sister, my parents, my children or my spouse, and my brother, sister and parents should be dependent. So 3D plus spouse, I'll repeat once again, if I am the assessee, then my dependent brother, my dependent sister, my dependent parents, my children, dependent or independent doesn't matter, and my spouse. So if the patient happens to be any of these people, only then the medical bills reimbursement will be exempt. Okay, what if the patient is one of these people, but the medical treatment happened in a private hospital? Not a specified hospital, guys. Medical bill reimbursement will be taxable. What if the medical treatment happened in specified hospital, but the patient is grandmother? Now grandmother is not coming in this list of relatives, so it will become fully taxable. So medical bills reimbursement also generally it is taxable. When is it exempt? Only if it is specified hospital plus specified patient. Okay, so reimbursements generally taxable, but you have only two exemptions to this rule. One is telephone bill reimbursement, mobile phone bill reimbursement, fully exempt for all employees, but medical bills reimbursement exempt only if specified hospital plus specified patient. Okay, then coming to our next perquisite, which is use of movable asset. See, use, I'm not talking about transfer, I'm talking about use. Use indicates employee is only having possession of the asset. The employer did not transfer the asset to the employee. The employer has only given possession of the asset to the employee. Okay, now once the employer has given the possession of the asset to the employee, what the employee does with the asset, it doesn't matter. Whether he uses it for just official purposes, whether he uses it for just personal purposes, whether he uses it for official and personal purposes, doesn't matter. Use, pure use of movable asset, you have only two tax treatments. Either if it is telephone, mobile phone, laptop or computer given just for use, it will be fully exempt. See, your answer will not change depending upon what the employee is using the asset for. Whether he is using it for official purposes, personal purposes, official personal purposes, doesn't matter. Telephone, mobile phone, laptop, computer given just for use will be fully exempt for all employees. If it is any other movable asset, like for example, if the employer has given a music system to the employee for use, or if the employer has given, let's say, refrigerator to the employee for use, so any other asset given to the employee just for use, you will check. If the employer owns the asset, then 10% per annum of the cost will be taxable. If the employer himself has taken the asset on hire, then hire charges paid by the employer will be taxable. Same like what we saw for furniture in RFA. Exactly the same thing. Okay, so if it is asset given just for use, not transferred, ownership is not transferred, employee is just having the possession of the asset, then if it is telephone, mobile phone, laptop, computer, it will be fully exempt. Any other asset, if the employer owns the asset, then 10% per annum of the cost will be taxable. If the employer has himself taken the asset on hire, then hire charges paid by the employer will be taxable. Okay, then comes my next part. This is where we talk about transfer. What if the employer is transferring the asset to the employee? That is, the employee is now having ownership of the asset, not just possession. Employer is transferring ownership of the asset to the employee. In that case, 4 steps, guys. You will see actual cost to the employer, you will subtract normal wear and tear, you will subtract whatever amount employee has paid to the employer, and you will find the taxable value of perquisite. Actual cost to the employer less normal wear and tear less amount recovered from employee, balance will be taxable. In this calculation, your most important step will be normal wear and tear. See, normal wear and tear, this is a terminology. You will not call it depreciation, because depreciation is a word we use only in PGBP. So because it is salaries head, you can't use the word depreciation. you will use the word normal wear and tear. Now when you're computing normal wear and tear, be careful. First of all, compute normal wear and tear only and only for the completed years for which the employer has used the asset for his business or profession. See, if the employer has used the asset at home, if he has used the asset for personal purpose, then you will not compute normal wear and tear. You will compute normal wear and tear only for those years for which the employer has used the asset for his business or profession. Okay, what if the employer had given the asset to the employee for use all these years? Even in this case, you will consider as if the employer has used it for business profession, and you will compute normal wear and tear for these years also. So you will not compute normal wear and tear only for those years for which the employer is using the asset for his personal purposes. You will compute normal wear and tear for those years for which the employer is using for his business or profession. You will also compute normal wear and tear for those years for which the employer had given the same asset to the employee for use. For those years only you will calculate normal wear and tear. Then you will compute only for the completed years. If any fraction, you will fully ignore. Okay. Now at what rate will you calculate this normal wear and tear? It depends upon what kind of asset. If it is computer, laptop, phone or electronic gadget, then 50% WDV basis. If it is motor car, 20% WDV basis. If it is any other asset, then 10% SLM basis. Okay. So with this guys, we're done with two important discussions in our salaries head. We've learnt about use of movable asset. We've also learnt about transfer of movable asset. Now let me straight away take you to the next perquisite, a very important perquisite, the motor car perquisite. Now I will be discussing this perquisite with you in three buckets. In our first bucket, the car is owned by the employer, even expenses are incurred by the employer. So tell me, your employee is enjoying how many benefits? Your employee is enjoying two benefits guys. Number one, he's getting the car, and number two, even the expenses on the car are also being met by the employer. So he's getting two benefits. Okay. Now what will be the taxable value of the perquisite? It fully depends upon what is the employee doing with the car. If the employee is using the car for only official purposes, then it will be fully exempt. Okay. But if the employee is using the car for personal purposes, then it will be taxable. Now how to compute the taxable value? I'll tell you. See, two benefits employee is getting, right? Number one, the car. So for the car benefit, you will take 10% per annum of the cost of the car. Second benefit is the expenses met by the employer. So that also you will tax. So 10% of the cost of the car plus expenses met by employer minus whatever amount employee has paid to the employer, this will become the taxable value of the perquisite if the employee is using the car for only personal purposes. But if the employee is using the car for official purposes also, for personal purposes also, then the taxable value will fully depend upon the cubic capacity of the car. If the cubic capacity of the car is up to 1600 cc, then 1800 per month will be taxable. If it is more than 1600 cc, then 2400 per month will be taxable. If along with the car driver is also provided, then you will add another 900 per month in this category. Okay. And one more thing, remember, in this category, whatever amount employee has paid to the employer, you will not consider that. You will ignore it. And lastly, in this point, in this category, you can have only one car. If the employer has given you more than one car in this category, then even though you are using for both official and personal purposes, only one car we will put in this category. Other cars we will treat as if used for personal purpose only. Okay. So this was your first bucket. What if the car is provided by the employer, even expenses are incurred by the employer? So my employee is getting two benefits, car also, expenses also. So if the car is used only for official purpose, nothing will be taxable. If the car is used only for personal purpose, then two benefits he is getting, right? So for the car benefit, 10% of the cost of the car you will take. For expenses, you will take whatever expense employer has met. You will subtract whatever amount employee has paid to the employer. You will get the taxable value. But if the car is used for official and personal purpose, this is where it totally depends upon the cubic capacity of the car. If the cubic capacity of the car is up to 1600 cc, 1800 per month will be taxable. If it is more than 1600 cc, 2400 per month will be taxable. If driver is also provided, in this category you will add another 900 per month. In this category, whatever amount employee has paid to the employer, you generally subtract, no, but in this category you should not subtract. And in this category you can have maximum only one car. And also remember, this category is taxable for specified employees only. Okay. Then comes my second bucket. In the second bucket, the car is owned by the employer, but the expenses are incurred by employee himself. So the employee is getting how many benefits over here? Only one benefit, and that is a car benefit. The expenses are being met by the employee himself. Only the car benefit he is getting. Okay. So if the car is being used by the employee for only official purposes, then nothing will be taxable. If the employee is using the car for only personal purposes, same thing. For only personal purpose, you will see how many benefits employee is getting. Employee is getting only one benefit, the car benefit. So for the car benefit, you will take 10% of the cost of the car, and whatever money employee has paid to the employer, you will subtract. Okay, but what if the car is used by the employee for both official and personal purpose? Again, in this category, I will look at the cubic capacity of the car. Up to 1600 cc, 600 per month will be taxable. More than 1600 cc, 900 per month will be taxable. Even over here, if driver is also provided along with the car, we will add another 900 per month in this category. In this category over here, we can have any number of cars. See, only in the first bucket we are saying that in this category we can have only one car, but in the second bucket, in the third bucket and all, any number of cars you can have, no problem at all. And even over here, whatever amount is paid by employee to the employer, you will not consider, you will ignore. Okay, so this is about the second bucket where the car is owned by employer, expenses are by the employee. So employee is getting only one benefit, and that is the car benefit. So if the employee is using that car for only official purposes, nothing is taxable. If he is using it for only personal purpose, you will see how many benefits he is getting. Only one benefit he is getting, the car. So for car benefit, you will take 10% per annum of the cost of the car. You will subtract whatever amount employee has paid to the employer, you will get the taxable value. But if the car is being used for both purposes, then it depends upon the cubic capacity of the car. Up to 1600 cc, 600 per month will be taxable. More than 1600 cc, 900 per month will be taxable. Same point in this category, in case the employee has paid any amount to the employer, you generally subtract. But in this category, you should not subtract. And in this category, if driver is also provided, you will add another 900 per month. And of course, yes, this bucket also, like the first bucket, first and second bucket will be taxed for specified employees only. See, in the first and second bucket, what is common? In both these buckets, a car is owned by employer. The difference is, in the first bucket, expense is also by employer. In the second bucket, expense is by the employee. So in the first bucket, employee is getting two benefits, car also, expense also. But in the second bucket, employee is getting only one benefit, which is the car benefit. Okay. Now moving on to the third bucket. The last bucket. Over here, the car is owned by employee himself, but expenses alone are being met by the employer. So here again, my employee is getting only one benefit, and that is expenses. He is himself owning the car. Only the expenses are being met by the employer. Okay. So only one benefit is getting, and that is the expense. So over here, you will start with the expense. Expense is a benefit, right? Employer is meeting the expense. So you will start with that expense, that how much expense is met by the employer. From that, you will subtract the official expense. Once you subtract official expense, you will get the personal expenses, guys. From this, you will subtract whatever amount employee has paid to the employer, you will get the taxable value. So if the car is owned by employee himself, expense is met by the employer. So the employer is giving us only one benefit, employer is giving us only the expense benefit. In that case, you will start with how much expense is being met by the employer. From that, you will subtract the official expenses. So you will get the personal expenses. From the personal expense, you will subtract whatever amount employee has paid to the employer, you will get the taxable value. Okay. Now in this calculation, the most important point will be how will you calculate the official expenses met by the employer? How to find how much expense was met by the employer? See, this will fully depend upon the logbook. Is the employee maintaining a logbook? If he is maintaining a logbook, you will get to know from there how much is the official expense. Okay, but if the employee is not maintaining the logbook, then it will depend upon the cubic capacity of the car. If the cubic capacity is up to 1600 cc, then 1800 per month will be not taxable value. I am discussing with you what is official expense. No, so official expense you will take from the logbook. But if employee is not maintaining logbook, then if the cubic capacity is up to 1600 cc, 1800 per month will be the official expense, not the taxable value. Official expense we are learning how to calculate now. So if the cubic capacity is up to 1600 cc, 1800 per month will be the official expense. If the cubic capacity is more than 1600 cc, then 2400 per month will be the official expense. And same thing if driver is also being provided along, if the employer is providing driver also, then you will add another 900 per month to the official expense. Okay, so over here, if the car is owned by employee himself, employer is helping you only with the expenses. Employee is getting only one benefit, only the expenses. So you will start with how much expenses met by the employer. You will subtract official expenses. You will get personal expenses. You will subtract whatever money employee has paid to the employer. You will get the taxable value. Now this is taxable for all employees, not for only specified employees. It is taxable for all employees. Only in the first two buckets where the car is owned by employer, only in these two buckets we say that it is taxable only for specified employees. But when the employee himself owns a car and employer is only helping you with expense, this is going to be taxable for all employees. In this calculation, the most most important computation will be official expenses met by the employer. If the employee is maintaining logbook, then you will take the numbers from the logbook itself. But if the employee is not maintaining logbook, then in that case official expense will depend upon the cubic capacity of the car. Okay, so this was your entire discussion with respect to motor car. Don't forget, first two buckets taxed only for specified employees and the last bucket taxable for all employees. Okay, coming to the next perquisite now, leave travel concession. So see, what happens in LTC is that the employee along with his family is going on a vacation. Okay, so when you go on a vacation, you will have travel expense. That travel expense is being met by the employer, not hotel expense. I'm talking about only travel expense. So whatever is a travel expense being met by the employer, it's a benefit for the employee because his travel expense employer is meeting. But it's going to be an exempt perquisite, a fully exempt perquisite. It will be exempt only if some conditions are fulfilled. First of all, who is traveling? Employee along with his family is traveling. Now family means what? Same thing which we saw in medical bills reimbursement also, 3D plus spouse, which means if I am the assessee, then my dependent brother, my dependent sister, my dependent parents, my children and my spouse. Now when it comes to children, here there's a special point. We have a limit of 2 children over here. See, where and all do you have the 2 children limit in your syllabus? I have already discussed this with you. Number 1, children education allowance. Number 2, children hostel allowance. Number 3, LTC. And number 4, section ATC, tuition fees, guys, only in 4 places. So LTC, one of the 4 places is what we're discussing now. So point number 1, who is going on a vacation? Employee along with his family is going on a vacation. If employee has 3 children, okay, and if all the 3 children travel expense is being met by the employer, then the LTC will be exempt for only up to 2 children. For the 3rd child, whatever travel expense employer is meeting, no, it will be fully taxable. Okay, so condition number 1, who is traveling? Employee along with his family. Then where are they traveling? Anywhere in India. We're talking only about domestic travel expense, not international travel expense. And number 3, what if the employee is going on a vacation every year? And what if every vacation employer is meeting the travel expense? Will each vacation travel expense met by employer be fully exempt? No, that will be too much exemption. We will give exemption only twice in a block of 4 calendar years. So in every 4 years, 2 times you can take exemption. The remaining travel expenses met by employer will be taxable. Only 2 times only you can take exemption. But if you don't even take any vacation, then you can carry forward 1 vacation to the next block of 4 calendar years. Okay, so totally there are 3 conditions, guys. Condition number 1, who is traveling? Employee along with his family is traveling. Now in family there is a catch that the exemption is only for up to 2 children. If there is more than 2 children, then for the remaining number of children, the LTC will be taxable. Okay. Now, but then about this 2 children point, there's one more thing, okay, which you have to remember, that if the children were born before 1st October 1998, we will not put this 2 children limit. If the children were born before 1st October 1998, the assessee can have any number of such children, the LTC will be fully exempt. Point number 1. Point number 2, if assessee is having multiple birth after 1 child, which means the first child is 1 single child, the second child is twins. So totally my assessee is having 3 children, guys. The first born is 1 single child, then assessee is having multiple birth after the first born. So totally your assessee is having 3 children. In such case, your exemption can be for all the 3 children. But if it is other way around, which means first born is twins, second born is 1 single child, totally your assessee is having 3 children, here exemption will be only for 2 children. For 1 child, it will be taxable. So if it is 1, 2, 3, then even though there are 3 children, exemption will be for all 3 children. But if it is 2, 1, 3, then exemption will be only for 2 children. For 1 child, it will be taxable. Okay, so condition 1, employee along with his family is going on a vacation. In family, we will include children also, but maximum only 2 children we will include. If assessee is having more than 2 children, then for the balance number of children, it will be taxable. Then the vacation is anywhere in India. If the vacation is outside India, then it will be fully taxable. And then the exemption is given only twice in a block of 4 calendar years. So if employee is taking 3 vacations in 4 years, then for 1 vacation, LTC will be taxable. Okay, and one more thing, what if the employer is helping you with business class tickets? Then the exemption will be only up to the economy class airfare only. Alright, and what if the employer is helping you with hotel expense also? There you will not get any exemption. Hotel expense will become fully taxable. Only travel expense only we will give exemption over here. Then one more special point is there, guys. What if the employee does not even go on a vacation and he simply encashes the LTC? Then it will be fully taxable. And lastly, there is no monetary limit. Like there is no limit that LTC exemption is only so much amount. There is no limit. Like for for gratuity you have a limit, for leave salary you have a limit. Like that for LTC there is no monetary limit. Okay, so this was your entire LTC discussion. Employee along with his family is going on a vacation anywhere in India, 2 vacations in a block of 4 calendar years. Travel expense which employer is meeting will be exempt. Hotel expense will be taxable, and if the children are born before 1st October 1998, I will not put the 2 children limit, and also if it is 1, 2, 3, even though I have more than 2 children, for all the children the exemption can be enjoyed. Okay. Then comes our next discussion, which is interest-free loan or loan at concessional rate of interest. Interest-free loan or loan at concessional rate of interest. Let me explain this to you straight away with the help of an example. Very simple perquisite, guys. Let us say the SBI lending rate on the 1st April of the previous year is 8%. Okay, which means the market rate is around 8%. Now the employee went and took a loan from employer. Employer is giving an interest-free loan, which means my employee does not have to pay any interest. So 0% interest. So how much interest is the employee saving? Employee is saving 8% interest, guys. So this will become taxable perquisite. This is interest-free loan. Now there is one more possibility. There can be a loan at concessional rate of interest. Loan at concessional rate of interest means the market rate is 8%, okay, but the employer is charging only 5%. So the employee is getting a benefit of 3%. This 3% will become taxable perquisite. So what we're talking about right now is 2 things: interest-free loan and loan at concessional rate of interest. In such kind of, if the employer is giving such kind of loan to the employee, then whatever interest the employee is saving, that interest which he is saving, that will become the taxable value of perquisite. Okay, but however, if the purpose of the loan which the employer has given, if the purpose of the loan is for medical treatment of Rule 3A disease, I don't care about the amount, the perquisite will be fully exempt. Okay. Or if the loan amount is within 20,000, I don't care about why did the employer give the loan. If the loan amount is within 20,000, it will be fully exempt. So if the amount is within 20,000 or if the purpose is medical treatment of Rule 3A disease, out of these two, if any one out of these 2 situations exists, then the entire perquisite will be fully exempt. Okay. Now here you have to understand about this 20,000 point a little bit more. See, when will you apply this 20,000 limit for each loan separately? No, you will apply this limit to aggregate of all the loans put together. So the aggregate loan you will look at, not separate loan. And will you look at the outstanding amount or will you look at the original amount? You will look at the original amount, not the outstanding amount. So aggregate loan, all the loans put together, not separately, put together, the original amount put together, if it is up to 20,000, then the perquisite will be fully exempt. Okay, so whatever interest your employee is saving, that interest amount which he is saving will become the taxable perquisite. But if the loan is for medical treatment of Rule 3A disease or if the aggregate original loan is up to 20,000, then nothing will be taxable. Okay, now let us say the loan is not for medical treatment of Rule 3A disease. Let us say the loan is more than 20,000, which means it is a taxable perquisite you have concluded. So 8%, 3% will be taxable. But 8%, 3% of what? 8% of what? 3% of what? You will see what is the outstanding amount at the end of the month. What is the outstanding amount at the end of the month? You will see 8% or 3% of the outstanding amount at the end of the month. So that is going to be your taxable value. Okay. Are you noticing for this 20,000 number, you will not look at the outstanding amount, you will look at the original amount. But once you have concluded it is a taxable perquisite, this 8%, 3% will be of what? Of the outstanding amount, not the original amount. Okay. Then we have a very special situation. What if the employer has given loan for medical treatment of Rule 3A disease? Okay, which means it is going to be an exempt perquisite. But for that same medical treatment, employee is also getting medical insurance compensation. So for the same disease, the employee got two benefits, guys. He first got a loan from the employer at low interest, at a concessional rate of interest. Then for the same disease, he got medical insurance compensation also. So two benefits he got for the same disease. So in such case, once he gets the second benefit, once he gets a medical insurance compensation, he will lose the exemption over here. It will become a taxable perquisite. Understanding? So medical treatment of Rule 3A disease, if the loan is for medical treatment of Rule 3A disease, if I stop over here, it is going to be an exempt perquisite. But if he is also going to get medical insurance compensation, then it's is getting second benefit. So once he gets a second benefit, this exemption which we gave over here, no, that exemption he will not have anymore. Okay, so this was about your discussion regarding interest-free loan and loan at concessional rate of interest. Then coming to the next perquisite, sweat equity shares or ESOPs. Over here, you will have an implication from the salaries head of income also, from the capital gains head of income also. Let's discuss them both. See, in the salaries head, you will see what is the fair market value of the shares, alright, fair market value of the shares minus whatever the employee has paid. Whatever the employee pays is called the exercise price. So whatever is the FMV of the shares minus whatever exercise price employee has paid, this balance will be the taxable value. Obvious guys, something which is worth 100 rupees, I paid only 60 rupees. So 40 rupees will be taxable. Same thing I am doing over here. What is the worth of the shares? That is FMV. Then what is the amount which employee has paid, which is exercise price 60 rupees. So the balance will become the taxable value of the perquisite. But here you have to remember that FMV you should take on which date? You should take FMV on the date of exercise of option, and this taxable value will be taxed when? It will be taxed only upon allotment. Okay, so only two dates are relevant for you, date of exercise and date of allotment. Alright, so salaries head will come into the picture when the employee gets the ESOPs, when the employee gets the shares. But what if the employee sells the shares later? Then capital gains head of income will be attracted. In capital gains head of income, you will do normal capital gains computation, guys. Only thing that will change is your cost of acquisition. See, the employee's cost actually is the 60 rupees. The employee's cost actually is the exercise price which he has paid, but we will not consider that. Instead, the FMV on the date of exercise of option, this will be considered as cost of acquisition. Understanding? So, his actual cost is exercise price, but we will not subtract exercise price in capital gains computation. Instead, whatever is the FMV on the date of exercise of option, this will be deemed to be cost of acquisition, and this is a number which will be subtracted in your capital gains computation. This was a simple adjustment about sweat equity shares and ESOPs. Okay, now this is not going to be new for you. I've already discussed this with you in various places. I'm just bringing it all together for you once again. Everything about transport. See, transport allowance, you will get 3,200 per month exemption, but only for blind, deaf, dumb and orthopedically handicapped employees. Then travelling allowance and conveyance allowance, whatever amount my assessee has actually spent for official purpose will be exempt. Balance will be taxable. Then, if the employee is working in transport sector and if he is getting an allowance to help him meet his day-to-day expenses, two things he will calculate. Remember, 10,000 per month or 70% of allowance received, whichever is lesser will be exempt. So, in all the three cases, received minus exempt, the balance will be taxable. Okay. Then coming to my next discussion, what about food related concept? See, food allowance or lunch allowance will be fully taxable. If the employer has given to the employee refreshments like tea, coffee, snacks or any non-alcoholic beverages, then it will be fully exempt. If food is provided in remote area, offshore location, also it will be exempt. But if food is provided in all other cases, then in that case, we will see what is the cost to the employer. We will subtract 50 rupees per meal. We will subtract whatever amount the employee has paid to the employer and we will get a taxable perquisite. So totally guys, there are four things over here. Number one, lunch allowance, food allowance, fully taxable. Then refreshments like tea, coffee, snacks, non-alcoholic beverages. I am not talking about proper food over here. I am talking only about snacks and refreshments. That's going to be always fully exempt. Okay. Now these 2 points are only about proper full course meal, full food, full lunch, full dinner, a proper meal. So if it's a proper meal being provided in a remote area or in an offshore location, then it will be exempt. But all other cases, it will be taxable. But how much will be taxable? You will see what is the cost to the employer. You will subtract 50 rupees per meal. You will subtract whatever amount employee has paid to the employer. The balance will be taxable value of perquisite. Okay. Then coming to a medical related discussion, everything about medical. See, if it is medical allowance, you know very well, it's going to be fully taxable. You know this. Medical bills reimbursement also, you know, generally it is taxable, but however, if it is, if the medical treatment happened in a specified hospital and patient is also specified patient, then it will be exempt guys. Then if it is a medical facility in a hospital which is owned or maintained by employer and the patient is a specified patient, here also it will be be fully exempt. So if it is a medical facility, see this is about medical bills reimbursement and this is about facility. If it's a medical facility in a hospital which is owned or maintained by employer and the patient is specified patient, same specified patient case. Specified patient means if I am the assessee, my dependent brother, my dependent sister, my dependent parents, my children and my spouse. Okay, so if the medical facility is in a hospital which is owned or maintained by employer, okay, and patient is a specified patient, it will be fully exempt. Then if it's medical insurance premium, if the employer is paying medical insurance premium for employee or for his family, even that is going to be fully exempt. So there are 4 points over here relating to medical. Okay, medical allowance and medical bills reimbursement you knew already. The new points for you are medical facility and medical insurance premium. Medical facility in a hospital which is owned maintained by employer and patient is specified patient will be fully exempt. Medical insurance premium paid by the employer for employee or his family also will be fully exempt. Okay, now coming to everything relating to telephone, all the 3 points you know already. Telephone allowance fully taxable, then telephone, mobile phone bill reimbursement fully exempt. Remember, reimbursements are always taxable, but only 2 exemptions you have. One is telephone, mobile phone bill reimbursement, always exempt. Secondly, medical bills reimbursement also generally taxable only. But if the medical bills reimbursement is relating to treatment which happened in a specified hospital and the patient is also a specified patient, then it will be exempt. Okay, so telephone allowance fully taxable, telephone, mobile phone bill reimbursement fully exempt. Then what if telephone, mobile phone, laptop, computer is given for use to the employee, which means employee is only having the possession of the goods. Employee does not have ownership, only use, only possession. In that case, telephone, mobile phone, laptop, computer is going to be fully exempt. All the 3 points you know guys, nothing new over here. Then comes my next discussion, everything about premiums. See, what if the employer is paying your medical insurance premium? Just now we learnt it's going to be fully exempt. What if the employer is paying your personal accident insurance policy premium? Fully exempt. Staff group insurance premium? Fully exempt. See, whatever premiums the employer is paying for you will be fully exempt except one, life insurance premium. If employer is paying your life insurance premium, it will be fully taxable. Okay, now see, if the employer is paying your life insurance premium, who will get ATC deduction? Will the employer get ATC deduction or will the employee get? The answer is neither. Neither of them will get. The reason is, see, who is actually paying? Employer. But is he paying for self, spouse or children? No, he is paying for his employee. So the employer will not get ATC deduction. Then what about employee? Is employee paying himself? He is not paying. His employer is paying. He is not paying. So even he cannot claim ATC. So for this life insurance premium which the employer is paying for the employee, neither can the employer claim ATC nor can the employee claim ATC. Okay. Then coming to the next discussion, we are going to talk everything about education now. See, there are totally 4 points only over here, out of which 1 point you already know. Education allowance, 100 rupees per month per child will be exempt for maximum 2 children. You already know this. In addition to this, there are 3 more points guys. Let's talk about them one by one. This first point over here is about employee's own education, staff training. Like for example, employee is attending one workshop, employer is meeting the expenses. So whatever expenses the employer is meeting for the employee's own training, for the employee's own education, it will be fully exempt. So employee's own education will be fully exempt. Okay. Then you have education reimbursement. If it is reimbursement, it's going to be fully taxable. Then comes education facility. See, reimbursement will be fully taxable. We will not even check anything else. Reimbursement itself means fully taxable. But if it is facility, if it is a facility, that is, it is in a school which is owned or maintained by employer, this is where full drama. Okay. See, reimbursement point, no tension, because we've already learnt about reimbursements. Reimbursements are generally fully taxable. Only 2 reimbursements you get exemption. One is your telephone, mobile phone bill reimbursement. Second is medical reimbursement, but only if it is in specified hospital and specified patient. All other reimbursements will be fully taxable. You already know it. So now our whole focus will be on the facility, education facility. This facility is in a school which is owned or maintained by employer. Okay. Now first of all, you will see who is getting educated. Is employee's own children getting educated or any other family member is getting educated? If employee's own children are getting educated, you will see what is the reasonable cost of education. If it is up to 1000 per month per child, it will be exempt. If it is more than 1000 per month per child, like for example, if it is 1200 per month per child, then 1200 will be fully taxable. I am not saying up to 1000 exempt, beyond that excess taxable, like that I am not saying. So if it's up to 1000, it's exempt. If it is more than 1000, it's going to be fully taxable. Okay. But however, if the student, the child who is studying in the school is any other family member, then you will not even compare with this 1000 number. No. If it is any other family member, whatever is a reasonable cost of education, it will be fully taxed. Whether it is less than 1000 or more than 1000, that doesn't matter in that case. So in simple words guys, you will check the 1000 rupees number only for employees' own children, not for other family members. Okay. So if it is education bill reimbursement, reimbursements are anyways fully taxable. So here also fully taxable. But if it is education facility, you will first stop and you will think who is getting educated. Is it employees' own children or any other family member? If it is employees' own children, then you will see what's a reasonable cost of education in a similar school. Up to 1000 rupees per month per child, up to that it will be fully exempt. Beyond that, if it is more than 1000 per month per child, then it will be fully taxable. Okay. And here there is no limit of 2 children and all. 2 children limit you have only in 4 places: children education allowance, children hostel allowance, LTC and ATC tuition fees. Only in 4 places you have 2 children limit. Here doesn't matter how many children, no limit on the number of children. Okay. Then comes your next discussion, everything about interest. See, we already know out of these 4 things, these 2 we already know guys. Interest from RPF up to 9.5% will be exempt. Beyond that, excess will be taxable. Interest from URPF, remember, URPF, when we withdraw the money, we will split into 4 parts. Employer's contribution to URPF, interest on employer's contribution to URPF, employee's contribution and interest on employee's contribution. Now, the interest on employer's contribution will go into the salaries head and interest on the employee's contribution will come under the IFOS head. These 2 we have already learnt just some time back only. Now, let's see the new points. What about interest from SPF? Interest from SPF, Statutory Provident Fund, will be fully exempt under salaries head itself. And interest from PPF, even this will be fully exempt, but this will be exempt under the IFOS head. So, 2 new points over here: SPF interest fully exempt under the salaries head and PPF interest also fully exempt but under the IFOS head. Okay. Then comes our next discussion. We are now going to focus entirely on retirement benefits: leave salary, gratuity, pension, voluntary retirement, then your retrenchment compensation. These retirement benefits are what we are going to see one after the other. Let's focus now. Leave salary. See, when it comes to leave salary, the first thing you will check is when did the employee receive leave salary? Was it during service or was it upon retirement? If the employee has received leave salary during service, it's going to be fully taxable. Any leave salary, doesn't matter what kind of employee, government employee, non-government employee, I don't care. Any kind of leave salary received by any kind of employee during service will be fully taxable. Okay. But if leave salary is received upon retirement, then you will see what kind of employee, government employee or non-government employee. Government employee, it will be fully exempt. For non-government employees, 4 things you will calculate. Out of the 4 things, whichever is the least will be exempt. What are the 4 things? Number 1, earned leave into average salary. Number 2, 10 into average salary. Number 3, maximum exemption which your employee can enjoy in entire lifetime is 25 lakh rupees and actual leave salary. So out of the 4, whichever is the least will be exempt. Received minus exempt, balance will be taxable. What are the 4 things? Once again tell me. Earned leave into average monthly salary, then 10 into average monthly salary, then maximum exemption which you can enjoy in your entire lifetime is 25 lakh rupees and actual leave salary. So out of these 4, whichever is the least, that is going to be exempt leave salary. Received minus exempt, balance will be taxable. Okay. Now let us try to understand how to calculate earned leave and how to calculate average monthly salary. See, for earned leave, you will first see how many years has the employee worked for. If there is any fraction, ignore the fraction. So first take the number of completed years of service, multiply that with how many days leave employee can take every year. What is the rate of earned leave entitlement? Rate of earned leave entitlement is nothing but in a year, employee is allowed to take how many days of leave. Like for example, let's say the employee has worked for 10 years, okay, and each year he is allowed to take 20 days of leave. So totally how many days of leave can he take in his entire period of service? 200 days. So A is nothing but how many years has your employee worked for. In my example, 10 years. If there's any fraction, you will ignore the fraction. Then rate of earned leave entitlement is nothing but how many days of leave employee is allowed to take in a year. In my example, it was 20 days. Now see, be careful, this number 20 days should not be more than 30 days. If it is more than 30 days, like for example, if the employer is letting you take 45 days leave in a year, even if it is more than 30, you will restrict it to 30. This can't be more than 30. Okay, so 10 into 20, this will become 200 days. This is the total number of days of leave which you are allowed to take. Okay, from this we will subtract how many days leave your employee has already taken. Let's say employee has already taken 50 days leave. You will also subtract whatever number of days of leave it is already encashed during service. Nothing but for how many days of leave, for how many days of earned leave the employee has already taken leave salary during service. So he has received leave salary during service for, let us say, 20 days. Okay, so the balance 130 days, this will become your earned leave. So earned leave will be nothing but A into B minus C. So A is nothing but total how many years have you worked for. If there is any fraction, ignore it. Even if it is more than 6 months, ignore the fraction. Then rate of earned leave entitlement, which is nothing but how many days of leave are you allowed to take in a year. It should not be more than 30. Even if it is more than 30, we will restrict it to 30. Okay. And C is two things. Number one, how many days leave you have already taken, and number two, for how many days you have already taken leave salary during service. So A into B minus C, this will give you your earned leave. In our example, to a total 10 years you have worked. Each year you are allowed to take 200 days leave. So this is A into B. From this I will minus C. C will have two things. Number one, how many days of leave you have already taken, and number two, for how many days you have already taken leave salary during service. So from A into B, from this number, when I subtract these two numbers, this will become our earned leave. Earned leave is also called as accumulated leave. It is also called as leave to the credit of the employee. Okay, so this is how you will calculate earned leave. Then how will you calculate average monthly salary? See, for average monthly salary, you are supposed to take 10 months average. 10 months average before, 10 months before what? 10 months before the date of retirement. Not before the month of retirement, 10 months before the date of retirement. And salary will have totally three components. Number one, basic salary. Number two, DA forming part. And number three, employees turnover based commission. There will be totally three components. So average salary will be how many months average? 10 months average. 10 months before what? 10 months before the date of retirement. Not 10 months before month of retirement. It's 10 months before the date of retirement. And salary will have three components: basic salary, DA forming part, and employees turnover based commission, three components. Okay, so with this you've understood the whole leave salary point. So any leave salary received during service will be fully taxable for all employees. Leave salary received upon retirement for government employees, it will be fully exempt. For non-government employees, you will calculate four things. Out of the four things, whichever is the least will be exempt. What are the four things? Number one, earned leave into average salary. Number two, 10 into average salary. Number three, maximum exemption which you can enjoy in entire lifetime is 25 lakh rupees. Number four, actual leave salary. Out of the four, whichever is the least will be exempt. Received minus exempt, balance will be taxable. How to find earned leave? To find earned leave, you will first see how many years has employee worked for. Then any fraction ignore. Then each year how many days leave employee is allowed to take. Okay, so A into B, 200 days. From this you will subtract two things. Number one, how many days leave you've already taken, and you'll also subtract for how many days you've already taken leave salary during service. So this will become your earned leave. So this is also called as accumulated leave, also called as leave balance or leave to the credit of the employee. Then we discussed how will you calculate salary. See, for salary, if you notice, we've always done salary computation in four parts, in four steps. We always start with date of retirement, right guys? It is not month of retirement, it is date of retirement. We start with this. Then after this, our second step is 10 months before the date of retirement. So before this date, we consider 10 months. Then for those 10 months, we calculate salary. That salary will have three components: basic salary plus DA forming part plus employees turnover based commission. Okay, so with this we will get salary for 10 months. Okay, then we need average monthly salary. So your fourth step will be whatever salary you got for these 10 months, that divide by 10, you will get your average salary. So 4 steps: date of retirement, then 10 months before date of retirement, then for those 10 months you will find salary, and then when you divide by 10 you will get your average salary. Okay, so with this we are done with our leave salary discussion. Now let's talk about gratuity. See, gratuity also same thing. If you are receiving gratuity during service, doesn't matter what kind of employee, gratuity during service will be fully taxable. But if the same gratuity is received upon retirement, then we will check, is our employee government employee or a non-government employee. Government employee receiving gratuity upon retirement is going to be fully exempt, same like leave salary. But however, if gratuity is received upon retirement by a non-government employee, first you will check the question, is the employee covered by POGA or is he not covered by POGA. If he is covered by POGA, then 15 by 26 into last drawn salary into number of completed years. You will do this as your first calculation. Second calculation, maximum exemption in entire lifetime is 20 lakhs. For leave salary, it was 25 lakhs. For gratuity, it is 20 lakhs. And number 3, actual gratuity. So out of these 3, whichever is the least number, that will be exempt, and received minus exempt, balance will be taxable. What are the 3 things? 15 by 26 into last drawn salary. Here last drawn salary will have only 2 components, guys. Basic salary plus DA. Full stop. See, I am not saying DA forming part. So you will consider all DA. Whether it is forming part, not forming part, doesn't matter, and you are not going to consider commission. Okay. Only 2 components, basic salary and DA, into number of completed years. Now when you calculate number of completed years, here you will consider the fraction. For leave salary, I said don't consider the fraction, but gratuity covered by POGA, you will consider the fraction. If the fraction is up to 6 months, you will ignore. If the fraction is more than 6 months, you will round up to the next number. Like for example, if the employee has worked for 15 years, 6 months, up to 6 months, you will ignore the fraction, you will consider as 15 years only. But if it is more than 6 months, like 15 years and 7 months, you will round up to the next number, 16 years. So here, yes, rounding off of, you will consider the fraction. You will consider the fraction. If it is up to 6 months, you will ignore the fraction. More than 6 months, you will round up to the next number. Okay, so if it is a non-government employee covered by POGA, then 3 things you will calculate. 15 by 26 into last drawn salary into number of completed years. Last drawn salary will have 2 components, basic salary plus all DA. Number of completed years, you will consider the fraction. Up to 6 months, you will ignore the fraction. More than 6 months, you will round up the fraction. Maximum exemption in entire lifetime is 20 lakhs. And actual gratuity. Out of these 3, whichever is least will be exempt. Received minus exempt, balance will be taxable. Okay. But what if the employee is not covered by POGA? If the employee is not covered by POGA, then half into average salary into number of completed years. This will be your first number. Second, same maximum exemption, guys, 20 lakhs. And third, actual gratuity. Out of these 3, whichever is the least will be exempt if not covered by POGA. Half into average salary. Now, how will you do this average salary calculation? Average salary will be how many months average? 10 months average. But 10 months before month of retirement. In leave salary, it was 10 months before date of retirement. Here it will be 10 months before month of retirement. So same 4 steps which I told you in leave salary, only one thing will change. Your first step will be month of retirement, not date of retirement, month of retirement. Your second step will be 10 months before this month of retirement. Then for these 10 months you will calculate salary. That salary will have same 3 components, basic salary plus DA forming part plus employees turnover based commission, same three components. Now this is salary for 10 months. So you will divide by 10 so that you can get the average salary. Same 4 steps I told you in leave salary also. There the only difference is instead of month of retirement, we have date of retirement. In gratuity, it is month of retirement. So average salary will be nothing but 10 months average salary, 10 months before the month of retirement. Here, number of completed years, what will you do with the fraction? This is very similar to leave salary, guys. So number of completed years, what do you do in leave salary also? You ignore the fraction, irrespective of what the fraction is, you always ignore the fraction. So even over here, number of completed years, you will straight away fully ignore the fraction, you will not consider the fraction. Okay, so 1 by 2 into average salary into number of completed years. Then maximum exemption which you can get in lifetime is 20 lakhs, actual gratuity. Out of these 3, whichever is the least will be exempt, received minus exempt, balance will be taxable. Now notice, here if employee is covered by POGA, last drawn salary is only 2 components, basic and DA. But if employee is not covered by POGA, salary has 3 components, basic, DA forming part and turnover based commission. Then one more difference, if employee is covered by POGA, when you are considering number of completed years, you do consider the fraction. But if an employee is not covered by POGA, any fraction over here you will fully ignore. Okay, so this was your gratuity discussion. So two retirement benefits you have discussed, you have understood leave salary and gratuity. Now come to pension. See, pension can either be uncommuted pension or it can be commuted pension. Uncommuted pension means it is periodical pension. Commuted pension means it is lump sum pension. Uncommuted pension is always going to be fully taxable. Doesn't matter government employee, non-government employee. Uncommuted pension is always fully taxable. But if it is commuted pension, which means lump sum pension, if government employee receives it, it's going to be fully exempt. But if your employee is a non-government employee, then the tax treatment of the commuted pension will depend upon is your employee also getting gratuity or not getting gratuity. If he is getting gratuity, then 1/3 of the full pension will be exempt. I am not saying 1/3 of the pension received is exempt. No, 1/3 of the full pension will be exempt. But if he is not getting gratuity, then half of full pension will be exempt, and same thing, received minus exempt, balance will be taxable. So commuted pension, non-government employee, the tax treatment will depend upon is your employee also getting gratuity or is he not getting gratuity. If he is getting gratuity, then 1/3 of full pension will be exempt. If he is not getting gratuity, then half of full pension will be exempt. Okay, this is about your pension discussion. Then comes retrenchment compensation. You will calculate three things. Out of the three things, whichever is the least will be exempt. Maximum exemption will be 5 lakhs. Actual compensation received 15 by 26 into salary into number of completed years of service. Here salary will be 3 months average, basic salary, DA, perquisites, LTC, and employees turnover based commission. Okay, here also up to 6 months you will ignore the fraction, more than 6 months you will round up the fraction. Not very important, so not spending too much time over here. Then voluntary retirement scheme, again 4 things you will calculate. Maximum exemption 5 lakhs, actual compensation received, last drawn salary into 3 into completed years, and last drawn salary into balance months. So out of these 4, whichever is the least will be exempt. Now what is this balance months? See, listen, this you should understand. Let us say my employee could have actually worked till he is 60 years of age, for example. But at 58 years itself, he is taking voluntary retirement. So what is the balance number of months? Balance number of months means if he did not take voluntary retirement, if he would have continued to work, for how many more months he could have worked. In my example, upon reaching 58 years, he took voluntary retirement. But had he not taken voluntary retirement at 58 years, he could have worked for 2 years more. He could have worked for 24 months more. So in our example, balance months will be 24 months. Okay, so balance months means if your employee does not accept voluntary retirement, but instead if he continues to work, then how many more months he can work for. That would be the balance number of months. Okay. Then if your employee is getting any health club facility or a sports club facility, okay, if this facility is for all employees and if it is at the employer's premises, so 3 conditions. Condition number 1, the facility should be health club or sports club facility. Condition 2, it should be for all employees, and condition 3, it should be at the employer's premises. Employee should not go to some other place for the facility. The facility should be available in the employer's premises itself. If all these 3 conditions are fulfilled, then that perquisite will be fully exempt. Okay, small point. Then ex gratia, if the question says assessee has received ex gratia, treat it just like bonus. Then a free transport. If free transport is provided to employees by airlines or to rail or by railways, it will be exempt. Like for example, if you are an air hostess, okay, then the airline for which you are working, that airline may give you free air tickets. So you are working in the transport sector and your employer is giving you free tickets. So airlines and railways, it will be fully exempt. All other cases it will be taxable. So you are an employee in the transport sector, you are a railway employee and railways is giving you free tickets, it will be fully exempt for you. You are an airline employee and the airline is giving you free tickets, it will be fully exempt. In all other cases it will be taxable. Okay, and then lastly section 16. Under section 16 you get deductions under your salaries head, right? Now totally there are 3 section 16 deductions. Number 1, standard deduction 50,000. Number 2, professional tax, which is total professional tax, whether paid by employer, whether paid by employee. See, when it comes to professional tax, whatever amount of professional tax is paid by employer, to that extent the professional tax will be taxable. But the total professional tax, whether paid by employer, whether paid by employee, the total professional tax will be allowed under section 16 on payment basis, which means it should be actually paid, only then it will be allowed. So totally there are 3 deductions under section 16. Standard deduction you will get 50,000. Then a professional tax doesn't matter who has paid, employee or employer, whoever has paid, put together, total professional tax paid will be allowed under section 16 on payment basis, which means you actually have to make the payment, then only it will be allowed. And number 3, entertainment allowance. This I have already told you. Entertainment allowance, you will get section 16 deduction only if employee is central government or state government employee. 3 things you will calculate: 5,000 rupees, 20% of basic salary, actual entertainment allowance received. Out of these 3, whichever is the least will be your section 16 deduction. Okay, so 3 things you will calculate out. So 3 section 16 deductions you will get under the normal regime. But if your assessee is following the default regime, that is 115 BSE, only one section 16 deduction you will get, that is standard deduction, and that is 75,000. Under the normal regime, standard deduction is only 50,000, but under default regime it is 75,000. Guys, professional tax point you understood, right? Whatever professional tax is paid by employer, it will first be taxed under your salaries head. Then the total professional tax paid, whether paid by employee, whether paid by employer, total amount paid, you will get deduction under section 16, but only under the normal regime. Okay, and now comes my last discussion under the salaries head. That see, the whole chapter we have learnt under the normal regime, right? But what if my assessee is following the default regime? So under 115 BSE, what are the changes in your salaries head? Number 1, LTC exemption you will not get. In the normal provisions, in the normal regime, if your assessee is getting LTC, 2 vacations in 4 calendar years, you will get exempt. No, that exemption you will not get under the default regime. LTC will be fully taxable under the default regime. Then allowances you get exemption, children education allowance, children hostel allowance, transport allowance, you get exemptions. No, so those allowances you will not get exemption, they will be fully taxable. But however, 5 allowances are there, guys. These 5 allowances you will still get exemption. Even under the default regime you will still get exemption. What are the 5? Number 1, transport allowance, 3,200 per month exemption you will get for blind, deaf, dumb and handicapped employees. Then number 2, travelling allowance, conveyance allowance, daily allowance. For these 3, whatever your assessee has incurred for official purpose, that much exemption he can enjoy. Then comes one more, the 5th point. This I will explain to you. Wait. So this alone I am keeping pending for now. Remaining points till here you understood. Under the normal regime, LTC you will get exemption, but under default regime, LTC will be fully taxable. Under normal regime, allowances you get exemption, HRA, children education allowance and all, you get exemption. But under the default regime, no exemption. But there are 5 allowances where you will continue to enjoy the exemption. That is transport allowance, travelling allowance, conveyance allowance, daily allowance, and one pending point is there. Then lunch perquisite, remember we learnt lunch which the employer is providing, you get 50 rupees per meal exemption, right? That exemption you will not get under the default regime. So 50 rupees per meal exemption not allowed if assessee is following the default regime. And the last point, the 4th point, guys, this I have just discussed with you. Under section 16, in the normal regime, you get 3 deductions. No, you get standard deduction, you get professional tax paid and entertainment allowance for central government employees, state government employees. But if assessee is following 115 BSE, then only one deduction you will get, which is standard deduction. No professional tax deduction, no entertainment allowance deduction, and standard deduction also not 50,000, you will get 75,000. So totally there are 4 changes in your salaries head if assessee follows default regime. First change is LTC exemption you will not get, LTC will be fully taxable. Second change is allowances will not be exempt, allowances will be fully taxable, but 5 allowances you can still continue to enjoy the exemption. Then third change, lunch perquisite 50 rupees per meal exemption you will not get. And fourth change, under section 16 only one deduction you will get, standard deduction, and that was 75,000. Okay. Now everything you have understood, only this point is pending. Let me take this up for you. I will discuss this with you over here. See, first of all tell me, where does your salary income accrue? Salary income accrues in the place where your assessee is rendering services. So wherever he is rendering services, that is where salary income accrues. This is the general rule. Okay. But But there is an exception. In that exception, there are 3 conditions. Condition number 1, employee is an Indian citizen. Condition number 2, the employer is Government of India. And condition number 3, the employee happens to render services outside India. If these 3 conditions are fulfilled, then even though the services are rendered outside India, still if all these 3 conditions are fulfilled, the salary income will be deemed to be accruing in India. Okay, not only the salary income guys, along with the salary income, this employee will get allowances also, perquisites also, everything you will consider as if it is accruing in India. After accruing in India, the salary alone will be taxable for these employees. Allowances and perquisites, these will be exempt. Okay. Now, right now I am talking about this exemption. This exemption you can continue to enjoy under 115 BAC also. This exemption you can continue to enjoy. You are understanding? Generally, under 115 BAC, for allowances, you don't get exemption, no. But this allowance and perquisite in this exceptional case, you can continue to enjoy exemption under the default regime also. You understood? Condition 1, employee is Indian citizen. Condition 2, employer is Government of India. Condition 3, the employee is rendering services outside India. If all these 3 conditions are fulfilled, then the salary income, even though the service is rendered outside India, still the salary income will accrue in India. Salary, allowances, perquisites, everything will accrue in India. After accruing in India, salary alone will be taxable. Allowances and perquisites will be exempt. This exemption you can enjoy under the normal regime also, under the default regime also. Okay. That's it guys. So with this we are done with our revision of our entire salaries head, and the best part about this revision was it was not a very bookish revision. If you've noticed, this revision was more from exam point of view, the kind of adjustments which they ask in the exam, okay, it is all those points which got covered for you through this revision. I'll close this over here. I'm hoping you're nice and confident with your salaries head. So now we are going to discuss 2 of the most scoring chapters in our syllabus. One is clubbing of income and the next is set off and carry forward of losses. See, the reason why I am calling them the most scoring chapters is not because you are going to get a lot of marks from here, no. The thing is, these are those 2 chapters where you have very little content to study and you get decent number of marks from here. You get around 7 marks from both these chapters put together and you have very little amount of content to study and they just can't complicate from here. So that is why let's revise these 2 chapters so nicely that whatever question they ask you from here, nicely you are able to tackle. Okay. Now let's start off with clubbing of income. In this discussion there will be totally 10 adjustments only. That's all. And with that you will get done. Let's start with the very first one. In the first adjustment, assessee's spouse is employed without any professional or technical qualifications. Straight away come to this diagram, you will understand. Let's say there is this person Blue and Green happens to be Blue's spouse. Okay. Now Green is employed in an entity. Now this entity can be company also, can be firm also, doesn't matter. This spouse is employed in the entity. But the spouse is employed in the entity without any professional or technical qualifications or experience. Okay. The spouse is earning salary from this entity. Understood? Point number 1, spouse is employed in the entity. Point number 2, the spouse is employed in the entity without professional or technical qualifications or experience. Now point number 3, from that entity the spouse is earning salary. Okay. Now in that same entity, Mr. Blue is having substantial interest. Blue along with his relatives is having at least 20% equity shares. If this was a partnership firm, then Blue along with his relatives should have at least 20% profit sharing ratio. So if these conditions are fulfilled, then whatever salary income is earned by Green from this entity, that salary income will be clubbed with Blue's income. That's all guys, simple as that. So condition number 1, spouse is employed in an entity. Condition number 2, the spouse is employed without qualifications or experience. Condition number 3, spouse is earning salary from this entity. And condition number 4, in that same entity, Mr. Blue along with his relatives is having substantial interest, which means at least 20% equity shares. See, here you have to understand one thing, okay. What if Blue is not holding any shares? What if only relatives are holding shares? Will you say that yes, this condition is fulfilled? No. Blue along with his relatives, which means relatives may own shares, may not own shares, doesn't matter. But Blue must have at least some shares in the entity. Only then this condition will get fulfilled. So Blue along with his relatives should have at least 20% equity shares in the entity. Okay. Now be very careful. Relatives means what? Relatives means plus spouse with arrows. So if I am Mr. Blue, my brother, my sister, my parents, grandparents, great-grandparents and so on, my children, grandchildren, great-grandchildren and so on, and my spouse. Okay. Now what if Blue and Green both are having substantial interest in the entity? And what if Blue and Green both are employed in the entity without any qualifications? Understanding? Both are having substantial interest and both are employed without any professional or technical qualifications. In that case, you will see Blue or Green whose income is higher. Whoever's income is higher, in that person's hands, both the salary incomes will be taxed. Okay, so this was your first adjustment. Now coming to the second adjustment, here there is transfer of income without transfer of asset. Now what is happening over here is, for example, let's say there is an FD in my name. I continue to own the FD. The FD is still in my name only. Only the income from the FD, that is FD interest, that alone I am transferring to you. So I am transferring income to you without transfer of asset. Transfer of income without transfer of asset. I'll give you one more example. Let's say there is a house property. I own the property. I continue to own the property. But the rental income from the property alone I transfer to you. So in all these cases where I transfer income to you but I don't transfer the asset to you, in that case whatever income you earn, it will be clubbed with the transferor's income. That's all guys. Second adjustment, I am transferring income without transferring asset. Whether it is revocable, irrevocable, doesn't matter. What is the relationship between me and you? It doesn't matter. The point is I am transferring income without transferring asset. So which it means whatever income I am transferring to you, you will be earning the income now, but that income will be clubbed with the transferor's income. Okay, so this was a second adjustment. Now comes the third point. This is extremely important. Revocable transfer of asset. See, let's understand this point by point. Okay. First of all, what exactly are we transferring over here? Are we transferring just income? No. Here we are transferring the asset itself. Okay. Then what kind of a transfer is it? Is it revocable transfer or is it irrevocable transfer? It is a revocable transfer. Now, what do you mean by revocable transfer? Revocable transfer means right now I am transferring the asset to you, but in the future I want either the asset back or I want the income back or I want both back. So it is a revocable transfer, which means even though I am transferring the asset to you, I am still keeping some rights in the asset. In the future, either I want the asset back or I want the income back or I want both back. Okay. Then comes the third point, that who are the parties? Are they related to each other? Not necessary guys. They may be related to each other. They may not be related to each other. It doesn't matter. See, totally 3 adjustments we've learned till now. No. In the first adjustment where we spoke about qualifications, salary and all, here we're talking only about husband-wife relationship, no other relationship. In the second adjustment where I was only transferring income and I was not transferring asset, here the parties may be related, may not be related, doesn't matter. Even in the third adjustment which I'm doing now for you, the parties may be related, may not be related, doesn't matter. So situation you've understood little bit. So we are transferring the asset itself, but it is a revocable transfer. Revocable transfer means I am transferring the asset to you now, but later I want the asset back or I want income back or I want both back. Okay. And the parties may be related, may not be related, it doesn't matter. Now if this is the situation, if I'm making a revocable transfer of asset to you, so even though you are the one who's earning the income, even though it is a transferee who's earning the income will be clubbed with the transferor's income. Clubbing provisions will apply. So if it is a revocable transfer of asset, clubbing provisions will apply. But this adjustment will not end so easily. There are totally 3 situations inside this adjustment which I will explain to you through the flowchart. See, let's take one example. Okay, let us say A and B are 2 people in the story. Now Mr. A, he is the transferor and B is a transferee. Okay, now A is transferring the asset to B and it is a revocable transfer of asset. So if I just say that it is a revocable transfer of asset, then in that case, yes, clubbing provisions will apply, which means even though it is Mr. B who's earning the income from the asset, the income will be clubbed with Mr. A's income. Okay, but however, if I say that yes, it is revocable, but it is revocable only upon the transferee's death. Yes, it is revocable, but revocable means what? Mr. A will get the asset back or he will get the income back or he will get both back. But he will get back only after B's death. If that is a kind of situation then, even though it is revocable, because it is revocable upon the transferee's death, we will treat it as if it is irrevocable. Okay, and if it is irrevocable, then of course guys, clubbing provisions will not apply. Alright, then comes the third situation wherein, okay, it is revocable upon transferee's death. If I stop with this, if I say it is revocable upon transferee's death, you will say, ma'am, no clubbing. But I am adding one extra tadka over there. I am saying that yes, it is revocable upon transferee's death, but during the transferee's lifetime, the transferor is enjoying some benefit from the asset directly or indirectly. Understanding? I'll repeat again. It is revocable only upon transferee's death, but during the transferee's lifetime itself, the transferor is enjoying some benefit directly or indirectly. If this situation arises, in that case, even if it is revocable only upon transferee's death, still clubbing provisions will apply. Understanding, everybody? Now see, I am saying over here that the transferor is enjoying any benefit directly or indirectly, which means I'll give you some examples. Maybe, for example, Mr. A transferred one house property to B. Okay, and 1% of the rental income he is going to enjoy during B's lifetime, or 1% of the rental income his spouse is going to enjoy during B's lifetime. Only 1%, guys, still clubbing provision will apply. Why? Because some benefit, they're not quantifying how much benefit. The law is not quantifying how much benefit. Law is saying some benefit the transferor is enjoying directly or indirectly. Directly means he himself is enjoying. Indirectly means his spouse, his children, his family is enjoying. So, in case it is revocable upon transferee's death, full stop, then no clubbing. But if it is revocable upon transferee's death, but during the transferee's lifetime, if the transferor is enjoying some benefit directly or indirectly, then clubbing provision will apply. Okay, and see, one small thing I'll tell you. Okay, I said in my example only 1% rental income the transferor is enjoying during the transferee's lifetime. So how much will you club? Will you club only this 1%? No. If clubbing provision will apply, then the entire income will be clubbed, not just this benefit which he is enjoying. The entire income will get clubbed. Okay guys, so this was your discussion regarding your third adjustment. Same thing is there in the flowchart itself. Flowchart I did not even use. You would have understood. I am very sure with this itself you would have understood. So totally 3 adjustments we have learned, guys. Tell me what was the first one. In the first adjustment, there is an assessee. He is having substantial interest in an entity. He along with his relatives are having at least 20% equity shares in the entity. In that same entity, his spouse is employed without any professional or technical qualifications and is earning salary from there. That salary will be clubbed with the assessee's income. Okay. In the second situation, we learned, wait. In the first situation itself, we had one more point, that what if both are employed in the same entity without qualifications and experience, and what if both are having substantial interest in the same entity. Then in that case, we said we'll see whose income is higher. With that person's income, both the salary incomes will be clubbed. Okay. Then our second adjustment was transfer of income without transfer of asset. Whether revocable, whether irrevocable doesn't matter, clubbing provisions will apply. In a third situation, there was transfer of asset, but it was a revocable transfer. If it is revocable transfer, clubbing provisions will apply. But if it is revocable only after transferee's death, clubbing provisions will not apply. If it is revocable only after transferee's death, but during the transferee's lifetime, if the transferor is going to enjoy some benefit directly or indirectly, again clubbing provisions will apply. Okay, you're perfect till here. Now come to my fourth adjustment in your clubbing provision. This is the most important adjustment from your clubbing chapter. Transfer of asset to spouse for no consideration or inadequate consideration. See, come to this diagram, I'll straight away help you understand from here, okay. Let us say there is this person Mr. Blue and another person Green. Green happens to be Blue's spouse, okay. Now Blue has transferred some asset to Green for no consideration or for inadequate consideration. Let us say Blue has transferred debentures to Green for no consideration or inadequate consideration. Okay, now who owns the debentures? Green will own the debentures. From the debentures, interest income, debenture interest income, who will enjoy? Green only will enjoy. But however, the debenture interest income will be clubbed with Blue's hands. In other words, if the assessee transfers any asset to his spouse for no consideration or for inadequate consideration, then from the asset, whatever income is earned by the spouse, that income will be clubbed with the transferor's income. Okay, so the debenture interest income that Green is going to enjoy, the debenture interest income which the spouse is going to enjoy, it will be clubbed with the income of the transferor, it will be clubbed with Blue's income, it will be taxed as if it is Blue's income. Okay, so now listen, let us discuss this entire adjustment in this diagram itself. So point number 1, what are we clubbing? We are clubbing income. We are clubbing income from transferred asset. Okay. Then let us continue our example. So from this debentures, debenture interest income, Green earned the debenture interest income you clubbed. Fine, story is over. Then Green was very smart. What she did is, whatever debenture interest income she was earning, she accumulated all that debenture interest income and she invested that interest income into one FD. And from that FD, she got FD interest. Okay. So tell me, will this FD interest be clubbed with Blue's income? The answer is no. What are we supposed to club? We are supposed to club income from the transferred asset. This FD interest, tell me, is it from debentures? No. This FD interest is from FD. This FD interest is actually income from income. Why? Because how did Green make this FD, guys? This FD was nothing but whatever debenture interest income she had earned, she accumulated the debenture interest income and that she invested into an FD, and from that FD she got FD interest. So this FD interest is actually income from income, and income from income we will not club, guys. Now let us say what Green did is, she is having these debentures. No, she sold these debentures. So if she sold these debentures, she will have capital gains. Will you club the capital gains with Blue's income? The answer is yes. Whatever capital gains is earned from the transfer of transferred asset, even that will be clubbed. Green transferred the debentures and is earning capital gains, even that will be clubbed. Now listen, when she transfers the debentures, do you agree the debentures have now changed form into money? Okay, and what she did with this money is that, let us say she bought shares of another company. Okay, now from these shares she is earning dividend income. Will that dividend income also be clubbed with Blue's income? The answer is yes, because we are supposed to club income from transferred asset in the same form or income from transferred asset in different form. See, the debentures have changed form into money. The money has changed form into shares. So shares is actually nothing but debentures only in a different form. So even income from this will be clubbed. So totally how many things will be clubbed, guys? Totally 3 things will be clubbed. Income from the transferred asset in the same form, income from the transferred asset in a different form, and also income from the transfer of transferred asset. These 3 things will be clubbed. But what will you not club? Income from income you will not club. Then listen, one last point, okay. Let us say she's having shares now, right? Company made a bonus issue. Company gave bonus shares. So bonus shares company will give to whom? To Blue or to Green? Company will give bonus shares to Green only, because Green only is the owner of these shares. So company, let us say, allotted bonus shares to Green. From those bonus shares, whatever dividend Green is earning, will you club that also? No, that will become income from accretions. Income from accretions we will not club. Bonus shares will become accretions. See guys, the rule is very simple. You are supposed to club income from the transferred asset in the same form or income from transferred asset in a different form. What do you mean by different form? Debentures have converted into money. Money have changed form. Money has changed form into shares. So shares will now become the transfer asset in different form. So from these shares, whatever dividend income Green earns, that will be clubbed with Blue. But however, the bonus shares are not these shares. No, they are in addition to these shares. Bonus shares are accretions. Accretions means they are in addition to the existing shares. So they will not be clubbed. Only income from these shares, only that will be clubbed. Perfect understanding, right? So see, if you need a little better clarity, come over here, come to this table. Income from transferred asset in the same form, yes, it will be clubbed. Income from transferred asset in a different form, yes, even this will be clubbed. Income from transfer of transferred asset, nothing but the capital gains which arises from the transfer of transferred asset, yes, even that will be clubbed. But income from income will not be clubbed, and income from accretions also will not be clubbed. Okay, now listen to one small point over here. In this entire adjustment, the asset can be any asset except house property. If Blue transfers a house property to his spouse for no consideration or inadequate consideration, this clubbing provision will not apply, because if assessee transfers house to spouse for no consideration or inadequate consideration, the deemed owner concept will apply. You know this, right? If assessee transfers a house property to his spouse, or if assessee transfers a house property to his minor child other than minor married daughter for no consideration or inadequate consideration, you will apply deemed owner concept in those cases and not the clubbing concept. Okay, then listen to one last point over here. Can love and affection be adequate consideration? See, love and affection can be consideration, but it can never be adequate consideration. And lastly, pin money and stridhan, these are the woman's own money. You cannot consider this as transferred asset ever. Pin money and stridhan will always be considered as the woman's own money. It's as if it is her own wealth. Okay, now before I go to the next point, one last concept in this adjustment I want to finish for you. That way this entire adjustment nicely we would have covered. See, understand, what if the assessee gives to his spouse 1 lakh rupees for no consideration or inadequate consideration? In my example, what is a transferred asset? The transferred asset is 1 lakh rupees cash, guys. Now, what the spouse did is, she put this 1 lakh rupees into her business. She invested this 1 lakh rupees into her business. So, can I say that the transferred asset cash 1 lakh has changed form into investment in business 1 lakh? So what the spouse did is, she put her own 5 lakh rupees in the business. Along with that, this 1 lakh which spouse gave, so total 6 lakh rupees she has put in this business. Now from this business, the spouse will earn profit. So don't you think this profit will become income from transferred asset in a different form? Because transferred asset is 1 lakh rupees cash which has changed form into investment in business. So this, any income from the transferred asset in same form or different form will be clubbed. So from the business, she is earning some PGBP, some income. That income will be clubbed with the assessee. But can you club this entire profit with the assessee? No, because this profit is from 6 lakhs investment. So proportionately only you will be able to club with the assessee's income. So this is where a formula comes into the picture. We will have to find from this business what is a PGBP. See, I am not saying profits from the business. I am saying PGBP, which means you will do all your adjustments, all allowances, disallowances from this business. Find the taxable PGBP of this business. Okay, that PGBP into investment out of transferred asset divided by total investment in the business. Like in our example, the investment out of transferred asset will be 1 lakh and the total investment will be 6 lakhs. So the net number that you get over here, this is what will be clubbed with the assessee's income. Okay, now before I take you any further, one small tiny last point, guys, listen to me. This numerator and this denominator both have to be as on 1st April of the previous year. Okay, but however, if the business was started in between the year, then you will take the numerator and denominator as on the date on which the business was started. So either the numerator and denominator will both be on the 1st April of the previous year, or the numerator denominator will be on the date on which the business was started by the spouse. Okay, whichever is later, of course. So this was your discussion with respect to transferring asset to spouse for no consideration or inadequate consideration. You understood this last part, right? Assessee is transferring money to spouse. The spouse is investing that money into business. So the transferred asset has changed form into business. So from this business, whatever PGBP the spouse earns, proportionately that PGBP will be clubbed with the assessee. Balance PGBP will be taxed as spouse's own income. Now see, in this adjustment in the examination, one more tweaking they can do. They can say that the spouse has invested this transferred asset into another firm as a capital contribution. Spouse is a partner in some firm and there she has invested this 1 lakh in her as a capital contribution. So now you can say that the transferred asset 1 lakh has changed form into capital contribution into partnership firm. So from the capital contribution, the spouse will earn interest on capital. No, that interest on capital proportionately you will club. See, from the firm, the spouse will get salary income also. That you will not club. From the firm, spouse will get share of profit also. That you will not club. From the capital contribution, the spouse will get interest on capital. That alone you will club. Again, same proportionately only you will club. Even over there, numerator, denominator both will be on the 1st April of the previous year. But in case the investment happened in between the current year, then you will take the numerator and denominator on the date on which the investment was made in the business. Okay guys, so here see, notice I am talking only about assessee and spouse, only about husband-wife relationship only I am talking about. Okay, so this was your fourth adjustment guys, your most important adjustment in your clubbing chapter. Now comes your fifth adjustment, wherein the assessee is transferring any asset to his son's spouse for no consideration or inadequate consideration to daughter-in-law. Okay, now here the same provision which we just now learnt, assessee to spouse, same provision will apply even over here. So if assessee is transferring any asset to son's spouse for no consideration or for inadequate consideration, then from this transferred asset, whatever income is earned by son's spouse, that income will be clubbed with the transferor's income. Even over here, we will club income from transferred asset in same form or in different form. Even over here, capital gains earned from the transfer of the transferred asset, even that we will club. Even over here, income from income will not be clubbed, and income from accretions also will not be clubbed. So same provision only, same provision which we had for assessee to spouse, the same provision is being applied for assessee to son's spouse also. There is one small difference, and the difference is when assessee is transferring asset to spouse, we are not covering house property guys, because we are saying if assessee is transferring house to spouse, deemed owner concept will apply, but deemed owner concept will not apply in assessee to son's spouse. In this relation, deemed owner concept will not apply. So indirectly, this provision, this clubbing provision will apply for all assets, including for house property also. The same clubbing provision only will apply. Okay, and guys, before I go forward, one small thing I forgot to tell you over here. What if between the husband and wife there is an agreement to live apart? Agreement to live apart means what if a divorce is going on between these two, and what if the transfer of asset happened because of the divorce? Then there will be no clubbing provisions. If both of them are under an agreement to live apart, if the husband and wife are going through divorce proceedings, then neither will the clubbing concept apply, nor will the deemed owner concept apply. Okay guys, so we're done with our first 5 adjustments. Now come to the 6th adjustment. In the 6th adjustment, assessee is transferring any asset to HUF. See, this transfer of asset we have seen in 3 places now. Assessee is transferring the asset to spouse for no consideration or inadequate consideration. Assessee is transferring asset to son's spouse for no consideration or inadequate consideration. Last point now, assessee is transferring asset to HUF for no consideration or inadequate consideration. So listen, if the assessee is transferring an asset to its HUF for no consideration or inadequate consideration, from the asset whatever income is earned by the HUF, that income will be clubbed with the transferor assessee. Same point only. Even over here, we will club income from transferred asset in the same form. We will club income from transferred asset in different form. We will also club income from transfer of transferred asset. Even over here, we will not club income from income, we will not club income from accretions, and over here, can the asset be house property? Yes, deemed owner concept will not apply when assessee transfers to HUF. Deemed owner concept will apply only when assessee transfers house to spouse, or if assessee transfers house to minor child other than minor married daughter. Only then deemed owner concept will apply. So here, even if it is house, even then the clubbing concept will apply. Okay, so transfer of asset for no consideration or inadequate consideration. For this adjustment, there are 3 relations: assessee to spouse, assessee to son's spouse, and assessee to HUF. Okay, now about the HUF, there is one more point, alright. In fact, there are 2 more points. See, if the member died and the assets were inherited by HUF, then clubbing provisions will not apply. I'll help you understand this. See, this person, Mr. Blue, he's a member of the HUF. He died, and in his will, he had written that after his death, his assets should go to the HUF. So, don't you think after his death, indirectly, his assets got transferred to HUF for no consideration or inadequate consideration? But this transfer was because of inheritance. So, in those cases, the clubbing provision will not apply. From the asset, HUF will earn the income. HUF itself will pay tax on the income. So, if the assets were transferred from Blue to the HUF upon Blue's death, then the clubbing provisions will not apply. Okay. Then see, there's one more point, the last point in this HUF discussion. The same story I am continuing. Okay, Blue had transferred some asset to HUF for no consideration or inadequate consideration. So from the asset, whatever income the HUF was earning, that income was clubbed with Blue's income. That is what we just now saw. Now understand what happened is the HUF was going through a partition. So if the HUF is getting partitioned, all the assets of the HUF will be distributed to the members of the HUF, guys. So upon the HUF's partition, it so happened that the same asset coincidentally went to that same blue's spouse. Understanding? So when the HUF got partitioned, that same asset went to pink and pink happens to be blue's spouse. So if this situation arises, now who owns the asset? The spouse. Who is earning income from the asset? The spouse. But the income will be clubbed with blue's income. This situation will arise only if, number one, there is a partition of the HUF, and number two, because of the partition of the HUF, the same asset is going to the assessee's spouse, not to anybody else, not to assessee's child, not to assessee's brother, not to assessee's mother, not going to anybody else, going to assessee's spouse only. Then again clubbing provisions will apply. Okay, so guys, totally 6 adjustments we have learnt in our clubbing chapter. Our first adjustment was the spouse salary qualifications, that adjustment. Second, we learnt transfer of income without transfer of asset. Then we spoke about revocable transfer of asset. Then we spoke about transfer of asset to spouse for no consideration or inadequate consideration, transfer of asset to son's spouse, and then transfer of asset to HUF. And now one more point we learnt, HUF is getting partitioned and the same asset is coming back to that transferor's spouse. Again clubbing provisions will apply. Okay, now let me take you to the 7th clubbing provision. In the 7th situation, the assessee is transferring any asset to any person. Okay, it can be any person, but the transfer is for the benefit of spouse or son's spouse. Like for example, let us say assessee transfers some asset to a trust, and it tells the trust that, see, listen, from this asset whatever income is earned, you must use that income for the benefit of my spouse or for the benefit of my son's spouse. Here, assessee is not directly transferring the asset to spouse or son's spouse. No, assessee is transferring the asset to some other person for the benefit of son's spouse or son's spouse, for the benefit of spouse or son's spouse. Even over here, clubbing provisions will apply. So this is your 7th situation, transferring asset to any person for the benefit of spouse or son's spouse. Okay. Then comes your 8th clubbing adjustment, extremely important again, minor child. See, any income that a minor child earns, that income will be clubbed with the parent's income. It will be clubbed with which parent's income? With that parent who is having a higher income. Now what if in year 1 the father's income is higher? You will club with the father's income. Now in year 2, if the mother's income is higher, will you change now? Will you club with mother's income? No. Once you club the income with the father's income, now you have to continue to club year after year with the father's income only. Only if the AO allows clubbing the income of the minor child with the other parent, only then it can be clubbed with the other parent. Otherwise, once you start clubbing the minor child's income with one parent, it has to be continued to be clubbed with that parent only. Okay. Now see, if the minor child is earning any income because of skill, talent or manual labor, clubbing provisions will not apply, which means the minor child himself will pay tax on those incomes. Also, if the minor child is disabled, even in that situation also, the clubbing provisions will not apply. Even in such cases, the minor child will pay tax on his own income, and because a minor child is disabled, he will be able to avail section 80U deduction also under chapter 6A. Okay. Now see, if the minor child's income is clubbed with the parent's income, that parent will get 1500 exemption per minor child. Okay. But this exemption you can enjoy under section 32 only if the assessee is following the normal regime. Under 115 BSc, under default regime, this 1500 exemption is not available. Okay. Now is there any limit on the number of children for this 1500 exemption? No, there is no limit on the number of children. Assessee can have any number of minor children. Per minor child, income is clubbed 1500, exemption the parent will get. See, the parent will get 1500 exemption only if the parent is following the normal regime. See, what kind of regime is the minor child following doesn't matter. The parent with whose income this minor child's income is being clubbed, that parent must be following the normal regime, then that parent will get 1500 rupees per minor child exemption under the normal regime. Okay. Now listen to one another point. What if the assessee is transferring a house property to minor child? Okay. Then for no consideration or for inadequate consideration, then in that case the clubbing provision will not apply. Why? Because instead the deemed owner concept will apply. But however, what if the assessee is transferring to a minor married daughter a house property for no consideration or inadequate consideration? If the minor child is a minor married daughter, then deemed owner concept will not apply. If deemed owner concept does not apply, then automatically, of course, the clubbing concept will apply. And also remember, you will get the 1500 exemption only under the clubbing concept and not under the deemed owner concept. Okay. So if assessee is transferring a house property to minor child, then don't apply clubbing concept, apply deemed owner concept, and in deemed owner don't give 1500 exemption. But if assessee is transferring house to minor married daughter, okay, then you will apply the clubbing provision and not the deemed owner provision. And under clubbing provision, yes, you will give the 1500 exemption. Alright, so this was your entire discussion regarding minor child. Now comes your 9th adjustment in clubbing, which is about cross transfer. First of all, what are cross transfers? A is transferring an asset to X's minor child for no consideration or inadequate consideration. X is transferring to Mrs. A for no consideration or inadequate consideration. So basically, A is transferring to X's minor child because X is transferring to Mrs. A. X is transferring to Mrs. A because A is transferring to X's minor child. So this becomes a cross transfer where both the transfers are consideration for each other, both the transfers are interrelated, both the transfers form part of a single transaction. It's a circuitous method being adopted by the parties to evade tax. So if there is a cross transfer, even though in reality Mr. A did not transfer anything to Mrs. A, we will treat as if Mr. A has transferred asset to Mrs. A. So, if Mr. A has transferred to Mrs. A, then clubbing provisions will apply. Right guys? So, in reality, Mr. A has not transferred anything to Mrs. A, but we will treat as if Mr. A has transferred to Mrs. A and clubbing provisions will apply. So, whatever income Mrs. A earns from the transferred asset, it will be clubbed with Mr. A's income. Alright. Now see, you have to be a little careful, okay, in cross transfers. Like sometimes the amounts are different. Like here 10,000, 12,000, two different amounts. So when there are two different amounts, you will consider the transaction as a cross transfer only to the extent of the lesser amount. So you will treat as if it is a cross transfer only to the extent of 10,000. So from this 10,000, whatever income Mrs. A is getting, that alone will be clubbed with Mr. A's income. Okay. From the balance 2,000, whatever income Mrs. A gets, that will not be clubbed. That will be taxed as Mrs. A's own income. Okay. Now coming to this side of the transfer. Here in our case, we have X and X's minor child. It can be X and Mrs. X also. See, if it is Mr. X and Mrs. X, alright, if it is Mrs. X over here, then in reality Mr. X did not transfer anything to Mrs. X, but because of cross transfer, we will treat as if X has transferred to Mrs. X and we will apply clubbing provisions. But over here, it is X and X's minor child. So whatever income minor child earns, this income is not because of skill, talent, labor and all. Minor child is not disabled also. So clubbing provisions will apply over here. So whether it is Mrs. X, whether it is Mr. X's minor child, income will anyways be clubbed. If it is X's minor child over here, income is going to be clubbed not because of transfer of asset. That is not the reason. If it is Mr. X's minor child, income will be clubbed with Mr. X because minor child's income is anyways supposed to be clubbed. And of course, because minor child's income is being clubbed, Mr. X will be able to enjoy 1500 exemption under section 1032 also, provided Mr. X is following the normal regime. Okay, this is about cross transfer. And then comes my last point guys, that if my assessee is following 115 BAC, then in the clubbing chapter what will get impacted? Only one provision will get impacted, which I just told you. Under the normal regime only you can take the 1032 exemption of 1500 for minor child's income being clubbed. But if assessee is following the default regime, if assessee is following 115 BAC, then this 1500 exemption you will not be able to enjoy. Okay, so this was your entire discussion with respect to your clubbing chapter, all the 10 adjustments we have seen. And now let's straight away start off our discussion on set off and carry forward of losses. Okay, see, whenever you do any question on set off and carry forward of losses, you will always follow this master sequence. You will always handle the current year losses first, only then you will go to earlier years brought forward losses. Now with respect to current year losses, you should always try to do intra-head adjustment first, which means, like for example, if you, so like for example, if you have loss from house property, you must try to adjust it against income from house property itself. So always first intra-head adjustment. But if intra-head is not possible, like I have loss from house property, but I don't have income from house property, so intra-head adjustment is not possible. In that case, you will second try for inter-head adjustment, which means like you can try adjusting loss from house property against salaries head or against PGBP. So this is inter-head adjustment. But if even inter-head adjustment is not possible, then no choice, we'll have to carry forward the loss to the next year. So you can carry forward the loss for how many years? Generally, you can carry forward the loss for 8 years. But however, there are two losses which you can carry forward for only 4 years. One is speculative business loss and second is loss from owning and maintaining racehorses. These two losses you can carry forward only for 4 years. There are 3 losses which you can carry forward indefinitely. Number 1, unabsorbed depreciation, unabsorbed capex on family planning, unabsorbed expenditure, scientific research expenditure. All this you can carry forward indefinitely. Also, your specified business loss where you're claiming 3580, even that you can carry forward indefinitely. Okay, so you will always handle current year losses first, and current year losses also first you will try intrahead. If intrahead is not possible, only then you will try interhead. If interhead is also not possible, you will carry forward the loss. You will carry forward the loss totally for 8 years, but if it is loss from owning and maintaining racehorses, or if it is speculative business loss, these 2 losses you will carry forward for only 4 years. And in case you have any unabsorbed depreciation or loss from specified business where you're claiming 3580, these 2 you can carry forward forever, you can carry forward indefinitely. Okay, now listen to one small point. In case your assessee files ITR late, okay, assessee can do intra-head adjustment, assessee can do inter-head adjustment, but assessee cannot carry forward the loss, cannot carry forward the current year loss to the next year. That we will not allow. But assessee can still carry forward, even if assessee files ITR late, assessee can still carry forward 2 losses. One is loss from house property and the other is unabsorbed depreciation, unabsorbed capex on scientific research, unabsorbed expenditure on promotion or family planning. This you can still carry forward even if you file ITR late. Other losses you can't carry forward. Loss from specified business 3580 you can't carry forward. If you file ITR late, only intra-head and inter-head you can do, but current year losses you can't carry forward except loss from house property and unabsorbed depreciation, unabsorbed capex on scientific research and unabsorbed expenditure on promotion or family planning amongst employees. Okay. Now listen, once you are done adjusting current year losses, then you will adjust the brought forward losses, earlier years, unabsorbed losses and all, you will bring forward to the current year and you will adjust. Whenever you bring forward earlier years losses to adjust in the current year, you can adjust in the current year intra-head only. Like for example, if you have last year's loss from house property which you are bringing forward to the current year you can adjust it only against income from house property. Okay guys, this is the most important part of your set off and carry forward chapter. Okay, now this I have already told you, if assessee files ITR late, then assessee can do intra-head adjustment, assessee can do inter-head adjustment. What is the problem? Where is the problem? The problem is only in carrying forward. You cannot carry forward current year losses to the next year, but you can still carry forward loss from house property and unabsorbed depreciation. No, you can still carry forward. But can you carry forward earlier years losses to the next year? Like for example, let us say in 23-24 you had some business loss, okay, which you brought forward to 24-25. Now 24-25 you filed ITR late. You were not able to adjust 23-24's loss in 24-25. You were not able to adjust. 24-25 you filed ITR late. Can you carry forward this 23-24's loss to the next year? Yes, all that you can do. See, earlier year's loss you can still carry forward. There is a problem. Problem is only in current year loss. You cannot carry forward to the next year, only current year loss if you file ITR late. But earlier year's losses you can bring forward. Earlier year's losses you can carry forward to the next year. Earlier year losses will not be affected. Only the current year loss will get affected. Current year losses only you can't carry forward to the next year. Okay, then listen to the next part. Always remember, you will do clubbing of income first and only then set off of losses. Once income is clubbed, against that clubbed income, you can set off your losses. Like for example, let us say minor child earned some income. I clubbed that minor child's income with my income. Now against that income, can I adjust my losses? Yes, I can adjust. When after clubbing the income, you will treat the income as if it is my own income, and against that you will let me adjust my losses. So always first clubbing of income, only then setting off of losses. Okay, and then listen to this next point. What if your assessee sells his business? Like let's say I was running a business, and that business I was making a lot of losses in the business. So I sold the business to another person. Now along with the business, will the losses also go to the buyer? No, I incurred the losses. No, so the losses will stay with me only. I can only set off and carry forward those losses. Those losses will not go to the buyer. But there is one exception to the rule, and that is inheritance. In case of inheritance, like for example, let us say the assessee died, okay, and after the assessee died, his business was inherited by his legal representative. So if the business is inherited by legal representative, along with the business, the losses will also go to the legal representative. Now from that inherited business, whatever unabsorbed losses were there, all those losses will be adjusted by the legal representative only. So generally, when I transfer the business to you, I only transfer the business, I don't transfer the losses, okay. But however, in inheritance cases, not only will you get the business from me, but also you will get the losses, unabsorbed losses also, you only will be adjusting, the legal representative only will be adjusting. Small point. Now comes some special rules relating to set off and carry forward of losses. First rule, listen carefully, LTCL you can adjust only against LTCG. STCL you can adjust against LTCG also, STCG also. So first rule, LTCL you can adjust only against LTCG. STCL you can adjust against LTCG also, STCG also. First rule. Then comes the second rule. In case you have any business loss or unabsorbed depreciation, they can be adjusted against any head. Only thing is, they can't be adjusted against salaries. So business loss and unabsorbed depreciation cannot be adjusted against salaries. Then comes the third special rule. In case you have speculative business loss can be adjusted only against speculative business income. Speculative business loss cannot be adjusted against any other business income. Speculative business loss can be adjusted only against speculative business income. Then comes your fourth special rule, which is regarding casual incomes. See, in case you have any casual incomes like lottery income, betting income, gambling income, or if you have any unexplained incomes like your cash credits, unexplained investments and all, or if you have any net winnings from online games, against these three incomes, guys, you can't adjust any loss, you can't adjust any expense. See, let us say you have some betting loss or some gambling loss, you will simply have to ignore that loss. From the same source, if you have any loss, you will simply ignore the loss. Against these incomes, you can't adjust any loss, you can't adjust any expense. These are like untouchable incomes. As it is, these incomes will be taxed at a flat rate of 30%. No Chapter 6A against these incomes, no losses can be adjusted against these incomes, no expenses can be adjusted against these incomes. How much ever you have over here, as it is, it will be taxed, story over. Okay, this is about your casual incomes, unexplained incomes and net winnings from online games. Now listen to the next point. There is one more point over here. I'll put it for you here. See, let us say my assessee is having a specified business. Okay, now if you are having a specified business, you may be claiming 3580, you may not be claiming 3580. Like for example, if it's a new hotel, I will be claiming 3580. But if it is an old hotel, or if it is a business which is formed with second hand assets and all, I cannot claim 3580. So specified business I have, and I am claiming 3580, let us say. From this business, I am suffering a loss. This loss you can adjust against business income of any specified business, whether you are claiming 3580 or whether you are not claiming 3580, it doesn't matter. If you have specified business where you are claiming 3580, from that business, if you are having any loss, that loss can be adjusted against income from any specified business, whether you are claiming 3580 or not claiming 3580, doesn't matter. Okay guys, then coming back to my discussion, so totally 5 special rules. First one I told you over here, LTCL only against LTCG, but STCL can be adjusted against LTCG also, STCG also. Then your second special rule was that business loss and unabsorbed depreciation can be adjusted against any income except salaries. Third rule was speculative business loss can be adjusted only against speculative business income. Your fourth rule was against casual incomes, unexplained incomes and all. They are untouchable incomes. Against these incomes, you can't adjust any loss, you can't adjust any expense. From the same category, if you have losses, you will ignore those losses. Then one more point I told you over here, if you have any specified business loss where you are claiming 3580, that loss you can adjust against income from any specified business income. You understood the significance of this word any. Any indicates whether you are claiming 3580, whether you are not claiming 3580, that will not matter. Okay guys, and finally after this, coming to my next discussion about loss from house property. See, in case your assessee is following the normal regime, and if you have loss from house property, of course you will first do intra-head adjustment, then you will do inter-head adjustment, but inter-head you can do maximum 2 lakh rupees only. If you have more than 2 lakh rupees loss from house property, the balance you only have to carry forward to the next year. You can carry forward for 8 years. You can carry forward also, you can bring forward also. So under the normal regime, loss from house property, you can do everything. You can do intra-head, inter-head, carry forward, bring forward, you can do everything. Only catch over here is, in inter-head, maximum you can do up to 2 lakh rupees only. If you have more than 2 lakh rupees loss from house property, you will have to carry forward to the next year, story over. Then in case your assessee is having, in case your assessee is following 115 BAC, the default regime, this is where the special point is. In the default regime, loss from house property, you can do only intra-head adjustment. You can't do inter-head, you can't carry forward to the next year, you can't bring forward from the last year also. Understanding, if you are not able to do intra-head, that's all, the loss will lapse. No option of inter-head or carrying forward, that option itself is not there. Extremely important from the exam point of view. Alright, and lastly guys, in case your assessee is following the default regime, your set off and carry forward chapter will be affected in 4 places. Loss from house property, I have already told you, you will only be able to do intra-head, everything else you will not be able to do. Apart from this, if you have any brought forward unadjusted loss of specified business claiming 35 AD, that is, you have any brought forward specified business loss where you claim 35 AD, that loss you will simply ignore. Then if you have any brought forward unadjusted contribution to outsiders for scientific research, see, under 115 BAC in scientific research, you can do in-house scientific research, but contribution to outsiders we don't allow under PGBP, no. So contribution to outsiders, if it is remaining unabsorbed, okay, if it is remaining unadjusted, even that we will ignore. And lastly, brought forward unabsorbed normal depreciation you can still adjust, but brought forward unabsorbed additional depreciation you will have to ignore. You will have to add it back to the block, you will have to reverse it, you will have to ignore it, but you can't adjust it against other incomes, unabsorbed additional depreciation. Okay, so over here the most important point is loss from house property, that if your assessee is following 115 BAC, loss from house property you can do only intra-head, no inter-head, no carry forward, no brought forward, only intra-head only you can do. And if assessee is following the normal regime, loss from house property you can do everything, but inter-head you can do maximum 2 lakh rupees only. Okay, so this was a discussion with respect to set off and carry forward of losses, clubbing of income, and your salaries head revision. Thank you guys, bye bye.